How's everyone doing this Saturday night, May 16th, 2026? You are in the strategy room with your host, the banker next door, Dr. Joe Berquist. I thank you, everyone, for joining me here on this lovely weekend. So we got a lot going on right now. There's a big Netflix. You got the Ronda Rousey, Gina Carano big fight coming up here in just an hour. But I know you're going to stick around and watch this before you flip over to that. Just kidding. Just kidding. Um, I know what's getting the views. I know what's getting the views. Yeah, a lot of other fights. Obviously, PGA championship going on this weekend, which is great to see. A lot of really close at the top there today. So I was pretty cool to watch. Can't wait to watch the rest of that tomorrow. But as far as tonight's show tonight, we've got a lot going on. We're going to be talking about a lot of inflation news. We got a lot of job number news. Our big story of the day, I'll bring this up for just a second. Our big story here of the week, Kevin Warsh confirmed as the Fed chairman in a 54-45 Senate vote, the slimmest vote for a new Fed chair in a very long time. So that obviously our big story there. We'll get into that in just a minute. I've got a lot of private credit news. I've got some very interesting real estate related articles. We've got some coverage of the Elon Musk OpenAI lawsuit, going on, but the courtroom drama. We're going to take a look at a bunch of that in there tonight. What else do I got for you guys this evening? A bunch of other banking related news. Obviously, a lot of crypto legislation news came out this week, so we'll be taking a dive into that later on into the program. But I'll tell you what, let's jump back in. And we'll jump into the things that we always do to start the show. We bringing up the U.S. debt clock here. So the U.S. national debt up to $39.251 trillion. That equates to debt per citizen of $114,000 and a debt per taxpayer of $357,000. The U.S. federal budget spending still at $7.1 trillion, with the U.S. federal budget deficit at $1.664 trillion. Now, interestingly enough, here it has on here Treasury reserves at $31 trillion and refund per taxpayer of $83,000. So, okay, if you want to look at that, I'm not really sure what to read into that, actually. But the debt to GDP is at 122%. Obviously, you can see here, 1960, we were at 52% debt to GDP. In 1980, we were 34% GDP. In 2000, we were at 57% GDP. And now we are at 122% debt to GDP. We're in a horrible debt situation, as it were. Horrible. Defense spending still at $937 billion. Interest on the national debt over $1 trillion now, just in interest to pay the national debt. Credit card debt still hovering at $1.331 trillion. That equates to a per card holder of $8,252. So there you go. Some of the key numbers that we always look at. Let's take a look at performance of the week overview. Stocks were down a lot yesterday. We're going to get into a lot of that. The interest rate numbers really popping yesterday due to bond markets. We're going to take a look at that in just a second. But you can see here as of yesterday, stocks, the Dow Jones Industrial Average had climbed back up just for a day, but it climbed back up over 50,000. But it dropped 537 points yesterday, so back down to about 45,500. NASDAQ also down a little bit, and the S&P 500 down a little bit, but both of those still at basically around all-time highs there for both of those. Let's take a look at currencies. Well, actually, let's go back to interest rates for a second. Big news yesterday. The 30-year bond went over 5%. Okay, went over 5.12% on the 30-year bond. That's something we had been watching and hoping that it was going to stay, probably just below 5%, but now it's over 5%. So now the real question is, do we continue to see this run up a little bit more? The 10-year Treasury note has now jumped up to, as you can see here, almost basically 4.596% here on this. I mean, just a big jump this week As you can see here from the blue chart over here to the left, I mean, we started out at basically 4.387, which is where it had been, hanging out roughly for the last couple of weeks. But I mean, just this jump up here to over 4.5%, almost 4.6%. Again, not going in the right direction, or at least the direction that we really want it to be in. Let's look at some of the other treasuries. 2-year treasury up now just a little bit over 4%. Remember how I've talked about for the last few weeks how we've had this very tight bandwidth between the short-term T-bills, basically the 1-year bill, 6-month, the 3-month, the 1-month bill, were all trading right at that like 3.7%. Actually started to see just a little bit of separation this week with that, especially from yesterday. So the 1-year T-bill basically going up to 3.8%, whereas the 6-month remained at 3.732, and the 3-month and the 1-year basically dropped just a tad to 3.6. So again, still very close bandwidth between, but just a little bit of spread there with them over the last 5 days. So again, interesting to watch, but obviously very concerning. I mean, this jump up in the bond market, just a very, very, very concerning thing here, because this is going to put the brakes on a lot of stuff if we continue to go this way, particularly. And I'm going to show you some real estate related articles in a little bit later when we get to them, because you're going to see, I mean, April sales were down because of higher interest rates on residential mortgages. That is it's going to cause us a problem. So, and then speaking of that, let's take a look at interest rates here today. So Treasury yields moved higher yet again on Friday, and mortgage rates followed suit as they typically do. According to rates from the Zillow Lender Marketplace, the current 30-year fixed rate is 6.41%, up 14 basis points from just yesterday. The 15-year fixed rate is up 8 basis points to 5.80, and the 5/1 ARM rose 14 basis points to 6.63%. Not devastating, but absolutely going in the wrong direction. Not going in the direction that we want to see it. And I think one of the big problems here is you're getting into that danger zone. If you creep back up to 6.5%, you start to go back over 6.5%. That could be enough in and of itself to really begin to slow things down. I think that you were really beginning to see real estate sales kind of pick back up just a tad bit. You're really looking forward to and hoping for a really good spring selling season. This is probably slowing that down. I would imagine in a big swath of the country, these rates are going to be impacting that and slowing it down. So, but anyway, let's take a look here. So the 30-year fixed again is at 6.41%. The 15-year fixed is at 5.80. 5/1 ARM is at 6.63%, and the 30-year VA mortgage is at 5.83%. On refinance rates, 30-year fixed rates at 6.29%. 15-year fixed is at 5.76. 5/1 ARM is at 6.34%, and the 30-year VA is at 5.81%. So again, not horrific rates. I mean, if you're looking to refinance and you want to get a 15-year mortgage and it's only 5.76%, again, not bad at all. I would take that. Yeah, not too shabby at all. But again, 30-year fixed, you're back up over 6% again. So that's where we stand on that. Now, let's get into a couple of these reasons. So why did the interest rates go up, right? This is the big question here. So U.S. sells 30-year bonds at 5% yields for the first time since 2007. Energy price shocks, inflation fears, and rising deficits are rattling global bond markets from Washington to Tokyo to London. And you know what? I'm going to make this just a little bit bigger here so everybody can see this. So the U.S. federal government has sold 30-year debt at auction at the yield above 5% for the first time since 2007. The Treasury Department sold $25 billion of new 30-year bonds on May 13th with an auction yield reaching 5.046%. Treasury bond yields represent the return investors receive for lending to the U.S. government over different periods. They move in the opposite direction to prices, meaning higher yields usually reflect falling bond prices or investors demanding a better return to buy the debt. The auction was part of the Treasury's wider May refunding plan. On May 6th, the Treasury said it would sell 58 billion in 3-year notes, 42 billion in 10-year notes, and 25 billion in 30-year bonds, while raising 41.7 billion in new cash from private investors. The rise in borrowing costs has been driven partly by an energy shock linked to the Iran war, which has lifted inflation and reduced expectations that the Federal Reserve will soon be able to cut interest rates. On May 11th, a host of global brokerages recast their projections for U.S. rate cuts in 2026 as the 10-week-old Middle East war has plunged energy prices higher. Global yields have probably come to the point where they are high enough to hurt sentiment. Between a resilient global economy powered by AI buildout and elevated energy prices, central banks are probably more worried about inflation. So yes, okay, fair enough. But then we also had the issue here this week, and I'm going to get to something else here in a second, of Japan basically dumping some debt, and basically Europe basically selling some stuff off. So that was also putting pressure. So then we get to this: mounting inflation pressures deepen global bond slot. So the yield on the 10-year Treasury climbed to nearly 4.6% Friday, its highest level in more than a year. A weeks-long rout in global government bonds intensified Friday, sending the yield on the benchmark 10-year U.S. Treasury note to its highest level in more than a year, and halted a stock rally that had just carried the S&P 500 and Nasdaq Composite to new records. Bonds had been hurt for months by the rise in energy prices sparked by the U.S.-Iran conflict, but they came under particular pressure on Friday thanks to a confluence of disparate developments worldwide, dragging down major indexes from Tokyo to New York, with the S&P 500 dropping 1.2% from Thursday's all-time high. The main headwind remains Iran. As the weeks go by without a deal, investors have become increasingly pessimistic that the U.S. and Iran will reach an agreement soon that would reopen the Strait of Hormuz and bring down energy prices. Investors had held out hope that President Trump's visit to China could yield some progress on that front, but were left disappointed by the results of the trip. Now, we will talk about that trip here in just a minute. Believe me, I did not forget about that. And again, just another chart here showing the rise in the yield on the 10-year Treasury, as we just looked at, getting up to almost 4.6%. Meanwhile, particularly sharp sell-offs in Japanese and UK government bonds spilled over into the US and other markets on Friday. So in Japan, price declines were powered by hot inflation data and signs that the government will borrow and spend more to blunt the impact of higher energy costs. In the UK, investors reacted to the growing threat of a leadership challenge to Prime Minister Keir Starmer, which raised fresh questions about the country's economic and fiscal trajectory. While concerns about domestic inflation have been growing, today's move in yields in the U.S., I think, are a direct result of what's happening in non-U.S. yields, said Leah Traub, a fixed income portfolio manager at Lord Abbett. Yields on treasuries, which rise when bond prices fall, are heavily influenced by investors' expectations for what short-term interest rates set by the Federal Reserve will average over the life of a bond. As the Iran conflict has dragged on, investors have started betting that energy prices will stay higher for longer than originally presumed, pushing the Fed to consider raising interest rates. That is a shift from before the war, when investors expected the Fed to cut rates this year. When yields rise sharply overseas, U.S. yields typically also rise to reflect the fact that investors can now buy higher yielding bonds elsewhere. Yields surged across the world on Friday. The yield on the 10-year U.S. Treasury note, a benchmark for borrowing costs across the economy, settled at almost 4.6%, its highest closing level since February of 2025. The yield on the 30-year U.S. Treasury bond rose 0.12 percentage point to 5.127%, its highest closing level since 2007. The Japanese 30-year yield jumped around 0.16 percentage point, while the UK 30-year yield surged 0.19 percentage point. Oil prices also rose in response to the lack of progress toward a Hormuz deal, with U.S. crude front month futures gaining 4.2% to $105 a barrel. So again, you saw a confluence of events. So basically, market disappointed that that the U.S. is not making more progress on the Iran deal. You got bad inflation data, which we're going to talk about in just a second here, that came out this week on not only CPI but PPI. Then you had this dumping of, basically you have, surge over in Japan and over in the UK, and their inflation and their energy costs and their interest rates, and therefore they also dumped some U.S. debt, and basically voila, there you go, higher interest rates there in the 10-year yield. So it wasn't any one thing, but a confluence of events that basically led to the increase in yields this week, particularly the massive jump we saw yesterday. So now let's talk about the inflation data for a few minutes here. So consumer prices rose 3.8% annually in April, the highest since May of 2023. So the consumer price index, otherwise known as the CPI, rose at a seasonally adjusted 0.6% for the month, putting the one-year pace at 3.8%, the highest since May of 2023. That's not good. That's not good. Excluding food and energy, the core CPI increased 0.4% and 2.8% respectively, keeping inflation well above the Federal Reserve's 2% goal. Though energy, and in particular gasoline, has been much of the headline story, inflation pressures also came from a variety of other areas. The report also contained bad news for workers, as real average hourly wages slipped 0.5% for the month and fell 0.3% annually. So just a couple notes on here. We're obviously going to talk a little bit more about gasoline in just a minute. But keep this in context. I mean, a lot of the other prices rose. Gas is probably the worst thing that you can have hit, right? Because gas touches everything. Like, in other words, you could look at it from this point. The United States runs on diesel fuel, right? It runs on diesel fuel. All the truckers around the country have to have diesel fuel to move all the product and get all the product where it needs to be. As their prices go up, our prices go up. Transportation costs go up. You see the drill. You know how the dominoes fall here. But there are also so many things. Everything. I mean, it's just like everything is made out of plastics. Your electronics, plastics, cars, plastics. Cell phones, plastics. Toys, plastics. Even your clothes, to a certain respect, have different. Can have different chemicals or require different types of oil to be made. It just gets. Oil is just plays a part in 70% of the things in your house are made in some way, shape, or form from oil. So as oil prices go up, of course, it's going to cause all these other things to go up, all these other prices to go up with it. So let's take a look at this for a second. Here's the inflation breakdown for April 2026 in one chart. So let's go down here. Obviously, it shoots right out at you right from the jump here. Maybe if I can try to make this a little bit, here we go. I'll try to make this a little bit bigger. Obviously, you see where the problem is. Like, you look at this chart. Tell me, what do you see? Oh, that's right. Gasoline. Yeah, gasoline's up 28.4%. That's a big problem. Energy overall is up 17.9%. Electricity is up 6.1%. What are some of the other big ones? Obviously, fruits and vegetables up 6.1%. But I believe that the increase in transportation costs is what is driving up a lot of this. It's not the only thing. Again, there's multiple factors to it, but I think that the increase in transportation costs is driving up a lot of the prices here on the food, because those transportation costs get passed off to the companies, to the distributors. They have to increase the companies. Then it goes down to the wholesalers. Then it goes down to the producers. It just rolls right on down. Boom, 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 boom. And let's take a look at some other things here. Apparel up 4.2%. All items less food and energy were up approximately 2.8%. Still 2.8% again, right around kind of the area it's been holding at for pretty much the better part of the last year or so. But airfare, up 20.7%. Again, why is airfare up? Because the cost of gas is up. So again, like I said, the gas is the real culprit here. This is what is driving all these other things. All these other things getting driven up by the price of gas. That's the reality of what is happening here. So then let's go over and take a look at this. So wholesale inflation jumps 6% in April on an annual basis, the biggest increase since 2022. And we all know how bad 2022 was. So the producer price index, also known as the PPI, rose a seasonally adjusted 1.4% for the month, much higher than the 0.5% Dow Jones consensus forecast for the upwardly revised 0.7% March increase. Energy was at the root of the unexpected high gain in producer prices, though there was evidence that the price pain is extending beyond the gas pump. Yes, absolutely. The services index accelerated 1.2%, the biggest gain since March of 2022. Two-thirds of the move was attributed to a 2.7% gain in trade services, a sign that tariff costs could be starting to have a larger impact on prices. So wholesale prices in April posted their highest annual increase in more than 3 years, signaling more not nettlesome inflation as pipeline costs intensify. Again, the PPI rose. We know all this, excluding food and energy. The core PPI accelerated 1% compared with the 0.4% estimate. Excluding food, energy, and trade services, the PPI rose 0.6%. Energy was at the root of the unexpectedly high gain in producer prices, as it was for a surge in consumer prices that the BLS Bureau of Labor Statistics reported Tuesday, though there was evidence that the price gain is extending beyond the gas pump. Some 3/4 of the gain in goods prices stemmed from a 7.8% jump in final demand energy, the BLS said. More than 40% of that was traced to a 15.6% surge in gasoline during a month when prices at the pump soared well past $4 a gallon as pressures from the Iran war hit the broader energy complex. While much of the inflation move has been attributed to the war and President Donald Trump's tariffs that were introduced a year ago, the PPI data shows the price pressures were broad-based. The services index accelerated 1.2%, the biggest monthly gain since March of 2022. Two-thirds of the move was attributed to a 2.7% rise in trade services, a sign that tariff costs could be starting to have a larger impact on prices. The move also was buttressed by a 3.5% jump in margins for machinery and equipment wholesaling. Inflation is sticky and accelerating. The core reading confirms a deeper structural trend, especially in services, said David Russell, global head of market strategy at TradeStation. The Hormuz crisis is aggravating the problem, but this goes way beyond oil. So, all right. Let's see here. And then going on to, and again, stay with me for a second. This is all going to kind of tie together here in a minute when you see it. So the Hormuz closure cuts OPEC oil production by 30% and threatens demand growth this year, the cartel says. So oil production among OPEC members has fallen by more than 30% or 9.7 million BPD since the Iran war started in late February. OPEC also lowered its demand growth forecast for 2026 to around 1.2 million BPD. That's barrels per day. Down from 1.4 million barrels per day previously. The International Emergency Agency sees demand falling by 420,000 barrels per day this year. The IEA warned the supply loss is rapidly depleting global inventories. Price volatility is likely ahead of peak summer demand, it said. And then we look to Saudi Aramco CEO says oil market won't normalize until 2027 if Hormuz disruption persists. The oil market will not normalize until 2027 if the disruption in the Strait of Hormuz persists past the middle of June, Saudi Aramco CEO Amir Nasser said. The biggest challenge facing the market is the disruption to the global tanker fleet, Nasser said. The fleet is mixed up, with tankers in the wrong places. He said the oil market will lose 100 million barrels of supply every week Hormuz is closed, the CEO said. The total net loss so far is 880 million barrels. So that gives us some indication here that basically, like, this is not good. This is not good. And I think that you're beginning to see the big problem here for the United States. So Iran, the issue here is that Iran knows that time ultimately, even though the US went in there, we bust up their navy and their air force and their drones and caused them all kinds of other problems. Yes, we know we did all that. But they also know that unless the US is willing to put ground troops in, which I think would be just the worst decision that we could ever make. Unless they're willing to do that, they can basically kind of stand us off, if you will. And the problem is that time is not on the U.S. side, because obviously, we've got for Trump politically, you've got the midterm elections coming up here in November. And this has already caused an issue that's going to carry through the summer. Like, this is already going to carry through the summer. We're going to see increased inflation. The Fed is going to be sitting there basically with their hands stuck. Even though Kevin Warsh is going in, he's not going to be in a position to lower interest rates. And as a matter of fact, they're probably going to be talking about raising rates. And this is just going to cause a lot of turmoil. And obviously, for political reasons, as we get out of the summer, this could be okay through the summer. Once you get toward the end of the summer and we start getting towards September, and all of a sudden elections are only 2 months away, and it starts getting a little bit more intense, you're gonna start to see and hear a lot of chatter from a lot of people about, just like, what do we do here? Why are we doing this? Why do we get involved in this? So again, time is not on the U.S.'s side in this regard. I mean, I think we might have a situation where it's like, okay, you might just have to wrap this up in a way that is not really much to your liking, just to basically get out of there, open the strait back up, and hopefully get production flowing again to where you can begin to start to get some of these prices back down. But this is just not good. I mean, this is going to wallop the American consumer, and people, as the summer drags on and these prices continue to inch up, your gas starts to inch up closer to $5 a gallon. People are not going to be happy. People's wallets are really going to be taxed, and it's not going to be a happy summer. It is not going to be a happy summer for a lot of people out there. All right, let's go to this. So gas prices lift U.S. inflation to 3.8%, the highest level in nearly 3 years. Shelter inflation also contributes to the higher than expected reading. So consumer prices accelerated for the second straight month in April as the war in Iran added to renewed inflationary pressures. The annual inflation rate rose to 3.8% from 3.3% in March. This is now the highest level of inflation since May of 2023. Last month's headline reading came in above the consensus estimate of 3.7%. On a monthly basis, the consumer price index rose by 0.6%. Gas prices have risen sharply since the outbreak of the 11-week-old conflict in the Middle East, up by about 50%. This is the result of soaring oil markets, with the barrel of West Texas Intermediate, the U.S. benchmark for crude prices, at more than $100. The national average for a gallon of gasoline is $4.50. According to the American Automobile Association, the food index also lifted April's inflation, rising by 0.5%. Supermarket prices advanced 0.7%, following the previous month's 0.2% decline. So again, you can see here, and let's go back to our numbers here let's go back to our prices here so we can see crude oil futures back up at $105. Brent crude futures back up to $109 a barrel. So again, not heading again, not heading in the direction we want it to head in. That is absolutely for sure. And then we get prices at the pump are wiping out wage gains. Let's see here. Americans' hourly wages are up. The problem, inflation is up even more. So we can see here prices grew faster, the CPI, Consumer Price Index, and then the average hourly earnings. So basically CPI at 3.8%, average hourly earnings at 3.6%. So again, not good. So for the first time in 3 years, inflation is outstripping growth in Americans' paychecks. Blame the gas pump. Americans are currently paying about $4.50 a gallon for regular gasoline, according to AAA, up more than 50% since the initial U.S.-Israeli attack on Iran in late February. Pay increases aren't keeping up. So April marked the first time inflation topped year-over-year growth and average hourly earnings since April of 2023, according to the Labor Department. Year-over-year changes offer a broader picture than more volatile month-to-month measures, which have also recently shown Americans' pay raises aren't measuring up to the rising cost of living. Americans are dealing with a math problem. While hourly wages rose a seasonally adjusted 3.6% on the year through April, the pace was mostly slowed over the past 4 years as hiring cooled from a post-pandemic hot streak. Meanwhile, inflation was 3.8% year over year, pushed up by surging fuel costs. After seasonal adjustment and rounding, the Labor Department said this leads to a 0.3% decline in inflation-adjusted hourly wages, also known as real hourly wages. So again, you can see here inflation-adjusted hourly earnings change from a year earlier. Again, not not going where we want it to go. And how do I want to say this? I mean, this is the economic recovery that Trump was working on, and things were really beginning to come together. Things were looking very good at the beginning of this year. This is killing it right now. I mean, there's just no other way to say it. That this conflict in Iran, this stalemate over the Strait of Hormuz, I mean, this is just driving up energy costs. It's got inflation going the wrong way. It's got now, wages aren't keeping up with the inflation here. Consumers are getting taxed. You got gas at the gas has gone up 50% at the pump. We're at $4.50 nationally, gas prices. None of this is good news. I mean, just none of this is good news. And again, it's not, and I don't mean to, it's not all doom and gloom, right? It's not all doom and gloom. We're not, it's not everything's not like in the toilet per se, but it's just not good. And I think that the problem is that I see this carrying through. I see this getting worse. It's going to get worse before it gets better. That is for sure. And it's going to get worse before it gets better, and it's going to carry through the summer. And I think that's the big problem. And I don't know, if it carries through the summer, not that it's not going to come down, but at that point, you might get to a point where this really begins to affect politics. This really begins to affect the midterm elections, because this is just dragging on, and affordability is, I guarantee it, affordability is going to be the number one issue come the midterm elections. It's gonna be, hey, we gave Trump 2 years here, and I got gasoline prices at $5, and I got milk at the grocery store up to almost $5 a gallon of milk. That's not gonna fly with people. That's not gonna sit well with people. So I like I said, I'm hopeful. I'm keeping my fingers crossed that something with the Strait of Hormuz can be worked out, and it can be worked out right quick. Because this, like I said, this is really, I see this over the next 3 months. As you get to the end of August, I see this really souring people. This is really going to sour people. It's not going to be good here. So anyway, all right, let's take a look now that we got that. Now that we've looked at inflation numbers, we've looked at gas numbers, let's take a look at the job market here for just a second. So how to make sense of this strange job market. It's a labor market unlike any other. Unemployment has drifted up, layoffs are low, hiring is slow, and the economy needs far fewer new jobs than it did before. So let's see. Look at a couple of these. Let me make this a little bit bigger, so everybody can hopefully see this better there. Hopefully, yep, I think it's better. So we've got our unemployment rate is still at 4.3%. That's good. As we like to say, anything below 5% is a good number. That indicates over full employment. So we're sitting here at 4.3%. And then we've got weekly jobless claims are also at a very low number of just below 200,000. So, US, weekly jobless claims are at a good spot. One reason it's so hard to interpret what's going on with the US job market these days is it is doing some puzzling things. Start with unemployment. On Friday, the Labor Department reported that the unemployment rate held steady in April at 4.3%. That is low historically, but notably above the multi-decade low of 3.4% it hit 3 years earlier. And yeah, I'm not even going to just forget that. That number was garbage. Yeah, we're not even looking at that. In the nearly 80 years, the Labor Department has been keeping records. However, the unemployment rate has made a clear turn higher. A recession has always followed. We've never had a period before where the unemployment rate has sort of just slowly increased for 3 years, said Harvard University economist Lawrence Katz. So again, here's the unemployment rate, and you can see here if we look at that's kind of the far right here, we can see it has been trending higher over the last couple of years. I look, my take on the Biden administration is that they were cooking the books with the job numbers like you wouldn't believe. We had millions of fake jobs that never existed, and they cooked the books like crazy on the job report. So these years here, 21, 22, 23, 24, you could throw all that right in the dumpster as far as I'm concerned, because I think all those numbers were hot garbage. And everybody knew the economy was not doing well under Joe Biden. Everybody knew that. Meanwhile, there have been some eye-catching layoffs from companies like Meta, according to outplacement firm Challenger Gray and Christmas's tally. Announced job cuts in the tech sector ran 33% higher in the first 4 months of this year versus last year. So again, announced tech layoffs. So I want everybody to understand something here with the tech layoffs, okay? The tech layoffs, they hired way too many people. I mean, you see a lot, you see this spike in layoffs here, spike in layoffs, spike in layoffs, spike in layoffs. After COVID, during and then right directly after COVID, they went on a hiring bonanza and they hired way too many people. And I really believe a lot of this is, a lot of the stuff you're hearing right now with like the AI, where it's like, oh, well, we've got AI now, so we don't need these people, whatever. Is there a little bit of that? Yeah, I'm sure there is. I believe that the bigger issue is that in 21 and 22, they hired way too many people, and they needed a reason to lay a lot of these people back off. And AI is the perfect reason. It's the perfect shelter for them to come out and basically say, oh yeah, sure, we can lay off whatever. And it's contagious, right? Once Meta starts to do it, then Microsoft starts to do it, Amazon starts to do it, they all start to do it. And for people who don't know, when you lay employees off, yes, those people are losing their jobs, but what happens to the company's stock price? When you lay off a bunch of employees, does your stock price go down? No, your stock price goes up every time. Okay, Meta comes out and says, "Oh, we just lopped off 3,000 people." Stock price right up. Okay, Mark Zuckerberg very happy. Okay, executives very happy. Okay, that's the reality of what happens when you have a big layoff. Because why? Because Wall Street reads that as you are right sizing. You are right sizing the company, right sizing the enterprise, right? But let's get back to this for just a second. So big private sector layoff announcements so far this year have been cooler than last year. More important, broader measures of firing activity, such as the monthly layoff figures the Labor Department gathers and the notices employers are required to file before doing large job cuts. Those are called WARN notices. I don't know if it's in every state, but I think in most states, if you're a major employer and you're going to lay a bunch of people off, you have to provide the state with what's called a WARN notice. You have to warn them basically that these layoffs are coming. Then there are the weekly initial jobless claim figures. These typically turn sharply higher when the labor market deteriorates, providing an early indication the trouble is coming. They have remained remarkably low. On Thursday, the Labor Department reported a seasonally adjusted 200,000 new claims were filed for unemployment benefits in the week ending May 2nd. By comparison, claims averaged about 218,000 during the pre-pandemic year of 2019 when the job market was unambiguously strong. So yeah, so you can see here weekly jobless claims, again, very low, very low. So basically, and we've gotten into this whole what do you want to call it, slow to hire, slow to fire mode, if you will, amongst employers. So the slow pace of firing has been paired with a low rate of hiring. However, confusion about what is going on in the economy has, as a result of tariff actions and more recently the war in Iran, could be playing a part there. So could the evolution of artificial intelligence, which could be making employers uncertain about what the shape of their workforces will look like in the years ahead. The result has been a job market without much movement. The sum of job separations, which includes people leaving their job for any reason, and hires as a share of overall employment, is well below where it was before the pandemic hit. So we could see here hires plus separations as a share of U.S. employment. And basically, we're up here to almost about 7%. I see right there. Let's see here. And then we get average, consumers' average expected probability that the unemployment rate will be higher in 1 year. So we got about a 44% probability that they think that people will think the unemployment rate will be higher in a year. Probably not. I really don't think the unemployment rate was really going to change all that much in the next year or so. I mean, unless something really wild happens, well, and who knows? I mean, it could, things could change. But again, I think you also have to keep in mind too that the government, we've seen this very large reduction in government employees, and that is also what has been playing in a very big way into the job numbers, because it kind of skews the job numbers. I mean, you kind of look at that and you're like, oh, well, the jobs aren't, only about 100 and some thousand jobs created over the last month or so. That's not really that great or whatever, but you have to take into consideration the government jobs that are the government layoffs are also affecting those numbers. You take the government layoffs out of it, you get a very different view of what's going on with the labor market. So, all right, now let's jump into this for just a second. So the changing job market leans against men. Industries have heavily employed men are losing jobs, and the share of men working has flatlined. So cumulative change in non-farm jobs since December of 2024. So jobs held by women has massively spiked up, and jobs held by men has been down, but it has popped back up here though, over the last month or so. So, but you can just kind of see here that it's the trend, right? The trend overall, like, women's jobs or jobs held by women just going up like a rocket. Jobs held by men really just, batting around here at the bottom of the barrel, so to speak. So, but let's take a look at this. So the American labor market is tilting away from men. Over the past year, nearly all net job growth has come from healthcare and social assistance, a sector with a dearth of men. Sectors with heavily male workforces have been losing jobs. The post-pandemic period has seen an influx of women in their prime working years into employment. The share of men working has flatlined. The divergent path might widen in the years ahead as the needs of an aging population stack up. Occupations that men have historically been loath to enter, such as jobs as home health aides and medical assistants, will likely play a bigger role in the labor market. A growing educational divide is also part of the equation. Women now earn bachelor's degrees at a substantially higher rate than men, and employment rates among people who are college educated are substantially higher than those who aren't. Friday, the Labor Department reported an overall unemployment rate. Yeah, we got this. Among men aged 16 and over, the employment to population ratio was 64.1% in April. That compares with an average of 66.6% in 2019 and 70.9% in the 1990s. A lot of that decline can be explained by an aging population. There are a lot more male retirees than there used to be. I think there's some other reasons out there. I think there are some other, DEI might be one to explain. H-1B visas might be one to explain. Yeah, there could be some. I think there could be some other really good reasons out there as to why that's happening. The share of women working has always been lower than men's, but it has held up much better despite an aging population. Women's employment to population ratio came to 54.5% in April, a bit below its 2019 and 1990s average. So employment as a share of population, you can see here men coming down, women going up. But they have, it is kind of interesting when you look at this longer term perspective. Since 2000, things really have kind of plateaued a little bit. I mean, when you look at, again, you go back up to this chart at the top here, you look at, just from 2025, again, going up like a rocket for women, men just, hovering around the flat line at 0%. But when you come down to this chart, you definitely see the men really coming down since the 1950s. And then you see the women really going up since the 1950s. But again, you get to about the year 2000, and you get to, like I said, you get to about 55% for women. You get up here now. Now men have continued to come down, but like you said, you get to about a hair under 70% for men, or around 70%, right around 2000. And men have continued to come down a little bit, but it's been, like I said, it definitely has been a little bit flatter. Which is interesting to note there. But like I said, I just wanted to point this out. Let's see if there's anything else in here. So again, another interesting chart here. Share of population age 25 to 54 with a bachelor's degree or higher. So you can see here, women, right around 2000. Women really overtook men in terms of the number of women getting bachelor's degrees at college. And the men have been behind kind of ever since. And and again, you see this gap is really, really widening. And I think I saw something not too long ago where I believe it said that basically the ratio of men to women in college, I think it was like almost like 60% women at this point, and like 40% men. I mean, something pretty close to that. Maybe like 58% women, 42% men, something in that range. But but again, that it explains this gap here. This major gap here. But again, I think there are a lot more deeper cultural issues, if you will, in our country that have led to a lot of these numbers. It's not as simple as like, oh yeah, women decided to jump back into the workforce, or more women in the workforce, and jobs that men have traditionally done are kind of dropping down, whatever. I think it's a little bit deeper, a little bit more complicated to that, and we all know some of these things that are going on out there for sure. So that's just, again, this is just to give us a little bit deeper look at the labor market and what's going on there. And like I said, we'll continue to follow some of this stuff, but again, a very interesting labor market right now, just with where everything are out. It's in certain respects, it could be a difficult market to gauge. And in certain respects, it might look a little worse than what it actually is right now. And I think the labor market, for the most part, is pretty good and pretty stable. But there are a lot of challenges out there. There's a lot of challenges for college graduates that are just graduating and coming out. It's a difficult job market. If you do get laid off and lose your job, finding another job could be a difficult, job market out there. So again, a lot of things going on, but a lot of employers are also apt to hold on to the people they have. Thus the low hiring, but the low firing. I mean, if you basically have good employees, you want to hold on to them right now. You don't want to get rid of them because it can be a little bit more difficult to replace them at the moment. So, all right. So now let's switch gears. Let's get into some of the Fed news here for a few minutes. So Fed Governor Stephen Miran submits his resignation, and he throws his support behind Warsh as the new chair. Now, this was The day before, I think this was the day. Oh no, I guess they were already voting for him on the 14th. So, but Fed Governor Stephen Miron officially handed in his resignation letter Thursday, saying he will vacate his spot on the central bank board when or just before new chair Kevin Warsh takes his seat. Miron has advocated for lower rates, voting against the 3/4 percentage point reductions the FOMC approved in 2025. This year, he voted against the 3 decisions to hold rates steady. So, Federal Reserve Governor Stephen Miron officially handed in his resignation letter Thursday, saying he will vacate his spot on the central bank board when or just before the new chair, Kevin Warsh, takes his seat, stepping in to fill what was left of an unexpired term last September. Miron served as a contrarian voice on the rate-setting Federal Open Markets Committee. He voted no in each of the 6 meetings he has attended since taking over for Adriana Kugler, who abruptly resigned in August of 2025. In his letter, Miron said his brief stint was the highest honor of my life and expressed confidence in Warsh, who gained Senate confirmation to the top seat on Wednesday. Miron came to the Fed after serving as chair of the Council of Economic Advisors. Going forward, I am excited about changes chairman designate Kevin Warsh and the Federal Reserve may make in areas such as communications policy, balance sheet policy, and keeping the Federal Reserve to its narrow mandate and out of hot-button political and cultural issues. Miron has advocated for lower rates, voting against 3/4 percentage point reductions the FOMC approved in 2025. This year, he voted against the 3 decisions to hold rates steady in favor of quarter-point cuts. In addition, he said he has pushed for a more forward-looking approach to monetary policy and believes the Fed needs to do a better job accounting for non-monetary forces and their implications for monetary policy. Specifically, he cited the impact of lower population growth and immigration on employment and deregulation as a disinflationary force. Okay, now finally getting to the big story of the week, right? 50 minutes into the show. All right. So Kevin Warsh is confirmed as the new Fed chairman in a 54-45 Senate vote. Divided vote signals challenge ahead for Warsh, who faces a Fed committee skeptical of rate cuts Trump has demanded. So the Senate confirmed Kevin Warsh as the Federal Reserve's 17th chair Wednesday in a largely party-line vote that reflected how tensions with the White House have dragged the Fed deeper into the political fray. Warsh, who was nominated for the post by President Trump in January, won confirmation from all Senate Republicans, but just one Democrat, John Fetterman of Pennsylvania. Senators Kristen Gillibrand, a Democrat from New York, didn't vote. No Fed chair has been confirmed by such a narrow margin since Senate approval became required for the job in 1977. Chair Jeremy Powell, whose leadership tenure ends Friday, captured at least 80 votes in Senate confirmations for each of his 2 terms atop the Fed. The previous chair, Janet Yellen, was confirmed 56-26 in 2014, with many senators absent because of bad weather. Oh, you gotta love it, man. Anyway, so a difficult economic backdrop and Trump's broadsides against the Fed independence have set up the central bank for a thorny leadership transition. At a Senate committee confirmation hearing last month, Warsh faced intense questioning from Democrats over how he would maintain the Fed's independence from a president who places priority on personal loyalty. Warsh said he would preserve the central bank's monetary independence and that he had made Trump no promises about policy decisions. Powell, citing concerns about political attacks on the institution, plans to remain on the Fed's board of governors, defying Trump's insistence that he leave. So, yes, this is going to get very interesting, everybody. Buckle up, because this is going to be very interesting. Now, a little bit on Warsh's background. I have covered this in prior weeks, but we'll just go read a couple paragraphs here for just a second. So Warsh is 56 years old. He has been immersed in monetary policy debates for decades, frequently as an outspoken critic of the Fed. A former Morgan Stanley investment banker, he became the youngest Fed governor in history at 35 years old when former President George W. Bush appointed him to the central bank's board in 2006. During the financial crisis that struck 2 years later, he played a key role tying up rescue deals that pulled Wall Street banks back from the brink. But By the time Warsh left the Fed in 2011, he had become a critic of its direction, concerned that as the economy recovered, the Fed's ongoing efforts to support financial markets went too far. Warsh joined Stanford University's Hoover Institution and was a partner at the hedge fund investor Stanley Druckenmiller's family office. He sought the Fed chair nomination during Trump's first term, but lost out to Jeremy Powell. During the COVID-19 pandemic, Warsh, who had long leaned toward a hawkish anti-inflation stance, warned presciently that the Fed's intensive efforts to support the economy could give rise to blistering inflation down the road. So, yes, absolutely. Now, I will say this about Warsh, and I said this before when I talked about his background. I do have some concerns. I have been highly critical of Jerome Powell over the years because Jerome Powell is not an economist. Jerome Powell is a private equity attorney. That's what he is. He deceives people in a very big way because a lot of people, he does what attorneys do. Attorneys are what are attorneys really good at? They are the good ones anyway are excellent at vocabulary. They are great at memorizing words and lingo and studying language for different industries. So he went out there and he learned all the economic lingo. He became very verbose and economic speak. And he wrote, he's very, very, I'm sure he's very good at writing briefs and things like that. Probably had many writing, putting together mergers and acquisitions and private equity and all that kind of stuff. And so I'm sure he's probably a very good writer. So he got very good at writing some of these economic speeches. Did he really understand what he was doing though? There's where it falls down. There's where I believe the answer is no. I believe it is a resounding no. And I believe that him and Janet Yellen and Ben Bernanke, the three of them, I call them the three amigos. I think the three amigos, they just did one after the next, just carried on the last one's policies and procedures and just followed it forward. Oh, yeah, we're going to do the forward guidance. We're going to do the QE. We're going to do the zero interest rate policy. We're just going to we're going to keep perpetuating the all bailout all the time economy. We're just going to continue to create bubbles. We're going to continue to do all this stuff. And I believe that in the years to come, people will look back on this period of Bernanke, Yellen, and Powell as the worst period of the Federal Reserve and the three worst leaders of the Federal Reserve. And the amount you cannot underestimate the amount of damage that they have done to the U.S. economy. It's unreal what they have done in the last 16, 17 years to the U.S. economy is it's beyond belief. And this is why I did the whole series on the Lords of Easy Money. If you've never read the book by Christopher Leonard, go out and read the book. I literally cover the entire book from start to finish. I cover every chapter. You could go to the YouTube page. You can go down to the playlist, the Lords of Easy Money playlist that I set up. You can watch all that, go through the book. But if you understand that book, you will understand what I'm talking about. You will understand, you will read that book and you will come away from that book basically like, yeah, they need to tear the Federal Reserve down. That's basically what you're going to come away with if you read that book. And I am a little reticent on Kevin Warsh because of a couple things. Number one, his background is kind of similar to Powell's, being from more of a legal background and not really being an economist per se, not in the traditional way, not in the way that like Volcker or Alan Greenspan, the way that these guys were true. I mean, even Ben Bernanke, to his credit, I mean, he was a true economist. Ben Bernanke was an academic, economist, so again, these guys were, some of those former Fed chairs were heavily steeped in economics, and it showed because I do believe that at least when they talked, like they knew what they were talking about, they understood what was going on. And I think that in a certain respect, especially with helicopter Ben Bernanke, I think that, that makes a lot of what he did even more egregious because he understood this stuff. He understood what he was doing. And then the other thing is that, when Warsh becomes the Fed governor at 35, youngest Fed governor in history. Now, when he's there from 2006 until 2011. So, yeah, he's there for 5 years. And when he's there, does he push back on anything? Does he have any dissenting votes? Does he? No, no. He totally plays ball. He's totally on board. He helps with putting together a whole bunch of the funny. He helps to coming up with a bunch of the rescue packages, all the bailouts for Wall Street and everything. He votes right along with Ben Bernanke on everything. No pushback. But then after he's out of there in 2011, also he finds Jesus. He finds Jesus when he gets out of there, and all of a sudden it's like, I didn't agree with any of that stuff, and I didn't like any of that stuff, and this, that, and everything, and and that's. And again, I believe there is definitely some truth to that. And I think you have to give people leeway because, again, I like to think that people do grow over time. People, I do believe that the vast majority of people, as they get older, they grow, hopefully all things, they grow wiser. And as they begin to learn more about in certain industries or the history of the industries, the history of business, the history of economics, and they just get more versed in a lot of these topics. They have more life experience. I believe that as people get older, a lot of those things come together, and they do look at things very differently. My father used to tell me all the time when I was a kid. He would say, as you get older, you're going to look at things when you're in your 40s, you're going to look at things one way. When you're in your 50s, you're going to look at things a certain way. When you're in your 60s, you're going to look at them. In your 70s, you're going to be different. 80s. So basically every decade that goes by, the more you learn, the longer you live, you're gonna begin to look at things a lot more differently. Some things more hopeful, some things more cynical. That's just the way it is, So again, I give him some leeway here, some benefit of the doubt. But like I said, I do have a few concerns there. I mean, I'm not going to say I'm totally without concerns with Kevin Warsh. But I would say this, though, my concerns are very different than, say, the Democrat concerns. I mean, the Democrat concerns were just a lot of I thought just nonsensical, oh, Kevin Warsh, you're worth a lot of money. Oh, you're rich. Like that's gonna affect how you do everything here. No, no, I don't really care about that. Kevin Warsh, the Fed has to stay independent, and this day you're going to be Trump's lapdog or whatever, blah blah blah. No, no, I'm not. I don't really. No, I'm not worried about that. Like that. That's like I said, like I have said many times before, I do not believe in Fed independence. If the Fed wanted to be a fully independent organization, they shouldn't have called themselves the Federal Reserve. Okay, that shouldn't be their name. Okay, they should be the Independent Reserve. Okay, of the not funded by the American taxpayer. Let's try that one. And I keep saying this: if the Fed is so independent, they don't need $2.5 billion from the American taxpayer to go build their Fed Mahal down there in D.C. How you like them apples? Yeah, the minute you bring that up, it's like the conversation stops, right? Wait, no. You can't have your cake and eat it too. You can't have it both ways. Okay. You can't cry to me about independence and then say, yeah, I need $2.5 billion to build my new headquarters over here because I got to have the champagne waterfall coming down, 24/7. It's just like, yeah, no. All right. Anyway, I digress. Let's keep going here. So here's an interesting article about this. So analysis. So Trump finally gets his man at the Fed. Will Kevin Warsh disappoint him? Very interesting. Kevin Warsh was confirmed on Wednesday. The new Fed chair faces a dangerous political environment, but he didn't get there by accident. He has a track record of winning over his critics. His tenure may be less explosive and more influential on the Fed itself than worries about his independence suggest. Yeah, pretty much feel along those lines. It has taken 8.5 years, but on Wednesday, President Donald Trump finally succeeded in reversing one of the few mistakes he has admitted to making as president. In November 2017, Trump chose Jerome Powell to chair the Federal Reserve, opting for someone he saw as malleable over a charismatic but youthful former Fed governor, Kevin Warsh. Trump has regretted it ever since. The question that has consumed the markets as the Senate moved toward Wednesday's confirmation is whether Trump will come to regret this decision too. Fed chairs change once they get the job, Trump said in January. If Warsh loses Trump's backing, the new Fed chair may not have the bulwark of congressional support that helped Powell resist Trump. Whether Warsh can succeed in the mission of regime change he has pledged for the Fed will hinge on his ability to navigate this exceptionally challenging political landscape. But while he starts his tenure at a significant political disadvantage compared to Powell, Warsh's history and his relationship with Trump suggest the new chair is more likely to blaze a more independent trail than his detractors believe. And he may do so in a collaborative way that would surprise those who are bracing for immediate friction. So yeah, I would have a tendency to probably agree with some of those comments. Um, again, some of these things he says he wants to try some different data or some different perspective there. I think that's a possibility that could probably happen. He says he wants to get rid of forward guidance. Yeah, okay, I'm sure he could do that. That's not really that big of a deal. But then he starts talking about the balance sheet. Can he wants to reduce the Fed's balance sheet, which I'm all for. I just don't believe you can reduce that balance sheet with causing all kinds of other problems and chaos in the market. And I just want to read one thing to everybody here. So this is from Federal Reserve Governor Michael Barr. Said shrinking the balance sheet is the wrong objective for the central bank and that many of the proposals to meet that objective would threaten financial stability. Barr made the remarks at a Midtown Manhattan event after Kevin Warsh's confirmation as Fed chair. It comes amid discussions about reducing the Fed's balance sheet to cut its footprint in the financial system. So, first of all, I think, Kevin Warsh is in for a lot of fights. I mean, particularly if Jeremy Powell is going to hang around on the Fed board, he is going to become basically a shadow chair, and Jeremy Powell will basically he'll basically start a civil war inside the Federal Reserve because Kevin Warsh will have some people on his side. Maybe 20 or 30% of the people will be with Kevin Warsh. The vast majority, probably 70%, maybe even more, will be behind Jerome Powell, so basically, and things could get crazy from there. And we're gonna see. We're gonna find. I think the next 6 months are going to be somewhat wild at the Fed. I think it may not be apparent. Another interesting aspect of this, it may not necessarily be apparent on the surface, but I think behind the scenes you're going to see a lot of turmoil, a lot of things roiling through there, and we will get things leaked out to us in dribs and drabs as they go along. And like I said, and we'll see what happens there. But obviously, the FOMC meetings are going to be barn burners. They're going to be barn burners. All right, so let's go to look at this. How 8 tumultuous years pushed Jerome Powell and the Fed to the limit. The pandemic, inflation, and White House pressure tested the central bank's leader as never before. For the last few years, Jerome Powell would walk past a portrait of Arthur Burns on his way to his office, addressing him silently. "I'm not going to be you." Burns, the Fed chair under Richard Nixon, embodied two failures. He allowed inflation to get out of control, and he yielded to a president who wanted lower interest rates. Powell faced both hazards, inflation and presidential pressure, and more during his 8 years as chair. The Fed won broad credit for its novel pandemic response, took a share of the blame for the high prices that followed, and confounded predictions by bringing inflation down without a recession. Powell then weathered the most substantial political assault on the central bank in its modern history. So, all right, I want to say a couple things here. In 8 years, as chairman of the Federal Reserve, Jeremy Powell never once hit his inflation target. The central bank said their inflation target was 2%. He never hit that 2% goal in 2 years. And not one time in 8 years did inflation ever come down to 2% or below. In 8 years, think about that. In 8 years, he never hit his target. Never. And they want to pat him on the back for his response during the pandemic, but he caused the inflation. He pumped, $4 or $5 trillion into maybe even $6 trillion into the economy during the pandemic. He caused the massive inflation. And then they it's like I said, I've often made the analogy about the Federal Reserve of basically like an arsonist. He firebombs your house, and then he shows up with the fire truck, and the media is sitting there going, "Oh, isn't he so great? He showed up with the fire truck to put the fire out." Yes, the fire that he started. The Fed always starts these fires, and then they always show up a few years later and to put it out, and the media is always there kissing their butt. Oh, the Fed's so wonderful, the Fed's so great, they did this great job or whatever. Like, yes, this was their fault. They caused this. Jeremy Powell, again, going back to the Lords of Easy Money, Jeremy Powell caused an entire blow up in the repo market, of course, but that all got swept under the rug when the pandemic hit, because then that was about to be front page news. His major bailout of all the hedge funds for blowing up the repo market. And then the pandemic hit, and that all got swept aside. And he was like, oh golly gee. Then inflation goes through the roof. He puts forth the most aggressive rate hike schedule in the history of the Fed. So then he hikes the rates through the roof. Then he is ultra slow to bring the rates back down. But meanwhile, he does start to bring the balance sheet back down. But then he causes, wait for it, liquidity problems in the market because he brings the balance sheet down too much. So again, Powell has not done us any favors. He is not a hero here. I'm sorry, flat out. He's not a hero. And I refuse to hail him as a hero. The guy is a buffoon who has messed up our economy beyond belief. And again, I could spend the next 45 minutes going through this article here. I'm not. I just wanted to touch on that first part. I'm probably going to do a separate episode just on this, because it's just a little bit longer article, and I would love to. I'd love to rip a few of these things apart. I really would. All right. You know what? Before I get into this, I'm going to switch gears here for just a minute. Let's get back into. Need to bring the blood pressure down here a little bit. All right, let's go. This is the portion of the show I like to give everybody the economic indicators for the week. I like to give everybody some banking news, and I like to talk about the episodes that I put out this week. So, first thing, hang on, let me get a. Okay. What are our economic indicators for the week? So on Tuesday, May 19th, we get ADP employment change weekly. We get the pending home sales, and we get the API weekly crude oil stock. On Wednesday, May 20th, we get the FOMC meeting minutes at 2 p.m. On Thursday, May 21st, we get initial jobless claims, continuing jobless claims, housing starts for April, manufacturing PMI, services PMI, 10-year tips auction. And then finally, on Friday, May 22nd, we get the Michigan Consumer Sentiment, U.S. Leading Index, and the Baker Hughes oil rig count. So some big stats this weekend, or this week rather, coming up. And we'll keep an eye on some of that stuff. So now, let's get into some banking news here, shall we? I got a lot of stuff here. Okay, FDIC releases public sections of informational filings for the six largest banks. So the FDIC released the public sections of informational filings for six large insured depository institutions. Retail sales increased in April. Business inventories grew in March. KC Fed deterioration in farm financial conditions is gradual. So, despite continued weakness in the crop sector, farm financial conditions have tightened gradually and stress remains limited, according to the Federal Reserve Bank of Kansas City. Producer prices rise in April. We talked about that. Mortgage applications increase, but I think that's a little bit misleading, just because the rise in rates over the last week wasn't really baked into that. But CISA and the G7 publish AI guidance. So the Cybersecurity and Infrastructure Security Agency and the group of 7 international partners published actionable guidance on what is reasonable to expect a software bill of materials for artificial intelligence. So kind of interesting. Small business optimism was flat in April. Consumer prices rise. We talked about that. Consumers expect home prices to grow 4% year over year. So, households expect home prices to grow by 4% over the next 12 months, according to the New York Fed. Households expect rents to increase by 8% over the next year, and homeowners' expected probability of refinancing in the next year rose to 9% from 8% last year. Existing home sales increase in April. ICBA raises concerns over Kraken pursuit of National Trust Charter. Yes, as I had reported on last week. So ICBA expressed strong concern after crypto exchange company Payward Inc., operator of Kraken, applied for a National Trust Bank Charter from the OCC. The application follows Kraken's previously granted access for a Federal Reserve master account. Yes, so we will keep an eye on that one. Wholesale inventories up in March. Consumer sentiment dips in early May. Fed's financial stability report highlights key risks. So, asset valuation pressures, borrowing by businesses and households, financial sector leverage, and funding risks are the primary vulnerabilities in the U.S. financial system, according to the Federal Reserve's semi-annual financial stability report. The report also noted near-term risks to the financial system, such as geopolitical risks as oil shock, risks from artificial intelligence, private credit, and persistent inflation. Let's see here. What else we got? FDIC releases study of deposit flows at 3 failed banks. So the FDIC published a staff study of deposit flows at 3 banks that failed in the spring of 2023. The agency said that using transaction level data from Silicon Valley Bank, Signature Bank, and First Republic Bank, the analysis provides a day-by-day look at depositor behavior around the time the institutions were closed and placed into FDIC receivership. Yes, I will absolutely be doing an episode on that. Cannot wait. I have that study. I cannot wait to dig in on that one and check that out. So keep an eye out if not this week, definitely by next week, but hopefully this week coming up, I'll have an episode out on that. So, okay, now some legislative news. So the Senate committee advances Clarity Act digital assets bill. So the Senate Banking Committee voted 15-9 to advance the Clarity Act legislation designed to establish a regulatory framework for digital assets. So again, there's been this whole stalemate with the Clarity Act. I've got some articles about this toward the end of the night here that I'm hoping to get to before we are done here tonight. But again, we made some headway here. Some new language came out, and we finally got through the Senate Banking Committee. So now it'll go before the full Senate for a vote. And depending on the changes they make to it, it might possibly have to go back to the House for another vote. But we'll see. We'll see what happens on that. Now, on the House side, the House committee advances ICBA-supported bills. So 4 ICBA-supported bills on advanced technologies and fraud detection and artificial intelligence passed out of the House Financial Services Committee with bipartisan support. 52-0. The AI Plan Act, which would require the Treasury, Homeland Security, and Commerce departments to issue a report describing interagency policies, procedures, and resources for combating the use of artificial intelligence in commission of financial crimes, including fraud. 52-0, the GUARD Act, a bill that would permit state, local, and tribal law enforcement agencies that receive eligible federal grant funds to use such funds for investigating elder financial fraud, pig butchering, and general financial fraud. Again, 52-0 on the Fostering the Use of Technology to Uphold Regulatory Effectiveness in Supervision Act, which would require the federal financial agencies to assess how their existing technologies pose challenges in conducting adequate real-time supervisory assessments of entities over which they have supervisor authority. And then the last one, 52-1, to advance the Bank Fraud Technology Advancement Act, a bill that would require the federal banking agencies to conduct a study on the use of advanced technologies in fraud detection and prevention, with particular attention to community banks. So, okay. And then the House applauds the House passage of pro-community bank regulatory reforms. So the House passed this week the SMART Act, the Trust Act, and the Advancing the Mentor Protege Program for Small Financial Institutions Act. So that's great. So a couple bills finally making it through the House, and then we'll see what happens when they get to the Senate. This is pretty cool. The CSBS announces winner of Community Bank case study competition. Now, I've been reporting on this for a couple months as this competition has been going on. This is an annual competition that is hosted by the Conference of State Bank Supervisors, and they announced that a student team from Tennessee Technological University is the first place winner of the 2026 CSBS Community Bank Case Study Competition. Teams from Illinois State University and Iowa State University won second and third place, respectively. So the competition provides students an opportunity to explore and understand real issues facing community banks. The Tennessee Tech team, working with its bank partner, gave readers an insider's view on how a community bank in Tennessee managed its balance sheet and interest rate risk in the face of significant inflation pressures in 2022. So so congratulations to everybody out there on that Tennessee Technological University team. Well-earned honor, and that is really good stuff. So okay, KC Fed ranchland values jump in the first quarter. So the Federal Reserve Bank of Kansas City reported that ranchland values in the 10th Federal Reserve District grew notably in the first quarter. ICBA and other groups urge action on AI-enabled cyber risk. So ICBA and other groups urge the administration to take coordinated action to address emerging AI-enabled cyber risk. So now, I did a whole talk on AI last week, where basically I said, as a matter of fact, I'll get to it in just a second, but I bit the strategy room bonus episode that I put out last Sunday was banks and White House changing approach on AI. So again, what again, on a real quick snapshot last week, the White House's their attitude toward AI has been full steam ahead. Full steam ahead, no questions. You know, the states want to pass regulation. It's like, nah, not going to allow it happen. We just need to let the tech bros run wild and do whatever they want. Then Mythos came out, and Mythos has now changed the game. And now all of a sudden, a lot of people are going, wait a minute, hold on, pump the brakes. Something's not right here. We need to check this out. And as I have advocated from the very beginning, I believe there needs to be guardrails around AI. There needs to be regulation around AI. There needs to be an AI, like an oversight body over the tech, wait for it, over the tech bros. And that means all of them. And if they want to put out something like Mythos, I say no. Like, no, you're not going to release this. You're not going to release it. And if we find out that you did release it, okay, we're going to mess your business up, basically. Yeah, and like I said, I've said it before, I don't care about their earnings. I really don't. I don't care about their earnings. They're playing with fire. They're playing with the equivalent of a technological atomic bomb is what they're playing with. And they could cause irreparable damage to the economy, to the world, to the U.S. And it's just we can't have it. We can't have it. There has to be guardrails around the AI thing. So, but all right. So the ICBA, so they sent a letter to the administration. ICBA and the groups highlighted the deeply interconnected nature of sector-wide risk and put forward a set of recommendations to strengthen the resilience and security of America's critical infrastructure sectors. So yeah, so now you've got groups basically calling the White House saying, whoa, we need to hold on, we need to pump the brakes here. We need to do something about, we need to address the AI issue a little bit. We can't have everybody just, it can't be the Wild West over here. We can't have everybody just running wild. Okay, the FDIC approves ICBA opposed Stellantis ILC charter, application rather. So the FDIC approves the application, the ILC application for Stellantis, obviously automotive dealership that owns, Chrysler, Dodge, everything else. And then finally, ICBA shares concerns on potential citizenship collection mandate amid ongoing conversations about a potential executive order requiring banks to collect and verify customer citizenship status as part of onboarding or due diligence. ICBA shared its concerns with administration officials. So, look, I'm a banker. I've worked in banking for a very long time. And I find it funny, almost comical, that we get the Patriot Act, that banks we got to do all this stuff around BSA, Bank Secrecy Act, anti-money laundering, got to fill out SAR reports and CTR reports on customers all day, every day, got to track everything that customers do, report everything that customers do, leave no stone unturned. We are, banks have become a police of the federal government, another arm, if you will, of the federal government in a certain respect. And yet, when the government comes and tells the bank that they want them to do all that they put this egregious regulatory burden on banks that costs them a fortune and has put a lot of banks out of business over the years. Thus, the massive consolidation within the business over the last 15 years. They, again, like almost like an abused child. The government comes forward. Okay, we're gonna put through the 1071 rule, and we're gonna do this, that, and banks are just like, okay, fine, yeah, okay, fine. But yet, all of a sudden, this administration says, you know what? You really need to start checking the citizenship of the people that you're banking. And then all of a sudden it's like, whoa, no. We can't do that. This is our line in the sand here. We need to fight against this. Like, first of all, it's not that hard to figure out if somebody is a citizen or not a citizen. It's not that hard. And it's not that hard to document that. I think the bigger issue there, especially for the bigger banks, is that if they got to suddenly start documenting all the citizens and then they got to report that information to the regulators, guess what you're going to find out? Yeah, you're going to find out that, like, Bank of America, Wells Fargo, Citibank, you're going to find out that they're banking a whole lot of illegal immigrants. Yes, you're going to find out that they're banking a whole lot of non-U.S. citizens here in the U.S., and that's what they do not want. They do not want that on the front page of the newspaper. So, of course, you're getting a lot of pushback in that regard. But like I said, it's almost comical, the things that the banking industry has accepted over the years without much pushback. But yet, when it comes to this, and this administration wanting them to basically check, citizenship status, all of a sudden it's a major problem. All right. All right. So what were the episodes that I put out this week? So I had 6 episodes out this week. First episode I put out was a bonus episode for last week's. That was taken out of last week's live stream. Like I said a few minutes ago, it was called Banks and White House Changing Approach on AI. It was from my whole AI discussion of last week. I'm not going to get into all of that. Just to say, hey, if you want to hear the kind of the AI, and I go through a ton of AI related information in that episode. So if you want to go check that out, go check it out. Then on Monday, I rolled out an episode called China is Rolling Up Its Rural Banks to Hide Massive Economic Issues. Now, people really like this episode. So, China's economy has been dealing with a number of issues over the last few years, mainly a real estate bubble collapse and trade issues with the US. These issues are spilling over into the banking system in the form of rural banks. Forced mergers are being used to stem potential chaos. The banks are being rolled up are known as village and township banks. Years of weak oversight, low capital, and risky lending have left these banks vulnerable. The pace of banks being rolled up is accelerating from 83 in 2024 to 226 in 2025 to 72 so far in 2026. The question is, how long can the banking system in China continue to hide their underlying issues through forced mergers? So again, I thought very interesting episode about what's going on with banks in China. And then on Tuesday, I jumped back into the private credit conversation. So private credit, so NDFI lending tightens, Apollo tries transparency, and HSBC gets pulled in. So problems in the private credit market continue to unfold as banks are now tightening lending standards around non-depository financial institutions. As this is happening, Apollo Global Management is trying transparency by offering their investors daily valuations for their private credit funds starting at the end of September. Now, most funds provide this information on a quarterly basis. Apollo is trying to calm down fears of larger credit issues within its funds. Meanwhile, HSBC is getting pulled into the private credit conversation through what are known as back leverage. When a company called MFS failed in February, they are a UK mortgage lender. Investors were trying to figure out who was going to absorb the losses. Through a chain of special purpose vehicles, HSBC turned out to be one of the most exposed banks and is now expected to take a $400 million loss. HSBC made a loan to, wait for it, Apollo Global, which then lent the money to MFS. So, yes, and this is something very typical of what we are seeing. It's a great example and very typical of what you see in the private credit market. So, okay, and then on Wednesday, I did another. So the last 2 weeks, I've done these episodes, what I'm calling bank news. So I have a series of articles. I might have 10 or 12 articles, and I just spend about 15 minutes or so just running through these articles just to give everybody a little bit of update of like what's going on in the world of banking. So in this week's episode, bank news, I basically had failed Oklahoma bank. First National Bank of Lindsay, ex-CEO Danny Siebel pleaded guilty to bank fraud and now faces up to 200 years in prison and a fine of up to $1 million. Cambridge Savings Bank has agreed to acquire First Seacoast Bank in an $80 million deal. Bay First Bank makes a change at CEO and carries out an $80 million capital raise. U.S. Bank takes a quieter approach to branch expansion. M&T Bank takes a patient approach to M&A. Kraken's parent company, Payward, is acquiring a Hong Kong-based payments infrastructure platform named Reap in a $600 million transaction. Anthropic continues to develop new AI offerings for financial services firms. Citi looks to scale AI agents across the bank. Citi is also making their pitch on improved performance. Chime found success with its AI agent, Jade. Chime is also facing 3 lawsuits over a potential data breach incident. And then finally, the Fed is looking to launch a roundtable that would focus on fighting payment fraud. So again, a lot of good information there in just that one quick episode. People are liking that format, so I might stick with that for a few more weeks and continue to see just how people think of it. The last 2 episodes on Thursday and Friday were basically covering reports that just came out. So on Thursday, I did a review of the Federal Reserve Senior Loan Officer Opinion Survey, also known as the SLOOS report for April of 2026. And then on Friday, I did a review of the OCC Semi-Annual Risk Perspective Report for the spring of 2026. So again, go check out those episodes for that analysis on those different reports. So, okay, those were the episodes for this week. So now let's get back to our articles if we can. So let's get into, so let's see here. I've got the last, half hour or so here, I've got real estate articles, I got private credit, I got crypto legislation. So and we also got the Elon Musk trial with OpenAI. So we're going to cover all of that here in the last 30 or 40 minutes. All right, so U.S. rents fall for a 33rd straight month as multifamily construction surges. So more than three-fourths of the top 50 metro areas recorded annual declines in rents, according to Realtor.com. So the U.S. renters may continue to save money as the national median asking rent fell for the 33rd consecutive month to $1,673 in April, according to a new report. At the same time, a surge in multifamily construction indicates a healthy supply of apartments could continue into the next few years. Realtor.com's April rental report, released on May 13th, shows median rents for all apartment sizes across the top 50 metro areas declined by 1.7% year over year, saving the average renter about $29 a month. More than three-fourths of these metro areas recorded an annual decline in rents. So again, that's great. It's great news. April home sales disappoint as higher mortgage rates weigh on buyers. So sales of previously owned homes rose just 0.2% month over month in April. Housing analysts had expected a gain of more than 3%. The average rate on the 30-year fixed rate mortgage ended March in the high 5% range and then shot up sharply in April due to the Iran war. The median price of a home sold in April was $417,700, up 0.9% from the year before. So obviously we talked a lot about interest rates earlier in the show tonight, but obviously sales, home sales, definitely disappointing. And like I said, I feel like this rise in interest rates, if this doesn't start to reverse or come back down in the next couple of weeks, I'm really worried that the spring selling season here is gonna end with a thud. But we'll see what happens with that. So now, interesting article here. Less than 11% of new construction is in urban areas, report finds. The report shows that nearly 80% of new homes for sale are located in suburban areas, compared with more than 55% of existing homes. So it's very interesting. So newly built homes across America are scarce in urban areas and carry a significant price premium, according to a report. In its May 7th New Construction Insights report, Realtor.com indicated that only 10.9% of new residential construction listings are located in urban areas, and that potential buyers may pay 78.4% more for these properties than for existing homes. Wow, that is quite the difference there. Nationwide, the median listing price for new urban homes is $738,000, compared with $414,000 for existing homes. For all new construction in both urban and suburban regions, the median listing price held at $449,000 in the first quarter. New construction is overwhelmingly a suburban story in the United States, and that has real consequences for buyers who want to live in cities. Urban new builds are difficult to deliver, and that difficulty is priced in. When a new home does come to market in an urban zip code, it commands a price that reflects just how hard it was to build there. According to a May land market report from the National Association of Realtors, the average land price per acre increased by 1.5% in 2025. Land sales also rose by 0.8%, faster than the 0.7% increase in 2024. Land search data show that the average land price is $18,000 per acre. Depending on the location, prices can vary from $1,000 to $100,000. Land values are also determined by access to utilities, infrastructure, and zoning regulations. Although Realtor.com said that nationwide, most new construction is located in suburban rather than urban areas, a few metro areas have most of their new construction listings in urban zip codes. So again, just very interesting, some very interesting details there. And then last thing I have this. So China's cash home buyers are undermining the American dream. So China leads the foreign rush to buy single-family homes in the United States. So as the U.S. housing market tightens, a growing number of Americans, especially young buyers, are discovering that the biggest obstacle isn't just high interest rates or limited inventory. In many cases, well-funded foreign cash buyers led by Chinese nationals are entering the market with advantages that most Americans simply don't have. Data from the National Association of Realtors shows the international transactions have increased from about 54,300 homes to more than 78,000 in the past year. This marks a clear reversal of the downward trend that followed the COVID-19 pandemic and global economic disruptions. Improved inventory levels and reduced competition from domestic buyers have created more opportunities for foreign investors, especially those paying in cash. So this is no longer a minor trend. It is a force that is actively hurting Americans in multiple ways, financially, socially, and strategically. Cash dominance is pricing Americans out. So Chinese buyers have become one of the most dominant foreign forces in U.S. real estate, accounting for roughly 1 out of every 6 foreign home purchases in the United States. In 2025 alone, they spent $13.7 billion on American homes. That amount represents an 83% increase over the year before. These facts matter because many of these purchases are made in cash. Of course, sellers prefer cash buyers because they're faster and more certain, and they don't need to wait on financing or approvals. This leaves typical American buyers who rely on mortgages at a severe disadvantage. Their offers get rejected and prices get bid up. This isn't just competition, it's structural displacement of American buyers by foreign capital. Targeting the homes that America needs most, and then leveraging a U.S. address for strategic advantage. A one-sided system that favors foreign buyers, and then economic and strategic concerns, and then policy solutions are gaining attention. But the bottom line, this issue is not an abstract economic theory. It's playing out in real time in neighborhoods across the country. Chinese nationals backed by significant capital and operating within an open U.S. system are driving up home prices, outcompeting American buyers. They're gaining access to U.S. institutions and benefiting from a system that society that they neither contributed to nor really value beyond what they could take from it. Meanwhile, American families are left trying to compete in a market that is increasingly stacked against them. The American dream was built on the idea that hard work could lead to home ownership. That promise is now under pressure, and not just from economic forces, but from global dynamics that policymakers can no longer afford to ignore. Yes, absolutely. So again, just some interesting trends here in the housing market when we look back across this. So we got, rents on, U.S. rents for apartments down for the 33rd straight month. April home sales disappointed. Less than 11% of new construction is in urban areas. 80% of all the development of new homes is in suburban areas. And then we have this issue of Chinese cash buyers basically coming in 78,000 transactions, in the past year of, just buying homes with cash, driving up the prices, crowding out American buyers. So again, this is really, really interesting stuff here. So, okay. Trump's trip to China. So Trump invites Elon Musk, Tim Cook, Larry Fink, and other CEOs to join the China trip for his Xi summit. So President Donald Trump invited executives that we already know to go out and meet Xi Jinping. Then we get to the Trump-Xi summit, the 3 big takeaways from historic meeting in Beijing. So let's see here. So U.S.-China geopolitical alignment. Xi's warning to Trump that mishandling Taiwan could put the U.S.-China relationship into great jeopardy. According to official English language state media, dominated headlines at the start of talks. Oil prices also rose after Trump told Fox News in a pre-recorded interview that China had agreed to buy U.S. oil and would help with Iran negotiations. And let's see here. And then trade truce holds. The U.S. and Chinese sides have not yet released details on specific agreements, but Trump's invitation to Xi to visit the U.S. on September 24th means the two leaders can't talk in person again before the expiration of the 1-year trade truce set in October of 2025. wins for business. Trump told Fox News that China will order 200 Boeing jets, which he said was more than the 150 units the company had expected, but that was less than half the 500 planes that many initially anticipated. NVIDIA also reportedly got the green light from the U.S. to sell its H200 chips to major Chinese companies, sending tech stocks higher. Both Boeing CEO Kelly Ortberg and NVIDIA CEO Jensen Huang accompanied Trump to Beijing. The executives and more than a dozen U.S. business leaders, including Apple CEO Tim Cook and Tesla's Elon Musk, participated in a meeting Thursday with Chinese Premier Lin Kuang. Okay, and then let's take a look at this. 5 takeaways from the Trump-Xi summit in Beijing so far. So then we got this. So new positioning. So Chinese President Xi Jinping and U.S. President Donald Trump agreed to develop a constructive China-U.S. relationship of strategic stability. Okay. Number 2, pre-summit meeting, balanced and positive. Okay. Number 3, deepening cooperation. Both sides should make a better use of diplomatic and military communication channels, Xi said. He also called for deeper cooperation in economic and trade issues, architecture, and tourism. I'm really trying not to laugh as I get through this list here. Number 4, Strait of Hormuz, oil purchase. The two sides also discussed the Middle East conflict, the crisis in Ukraine, and the Korean Peninsula, according to the Chinese readout, which did not offer more details. Number 5, Taiwan, the most important issue. So Xi reserved his sharpest language for Taiwan, calling it the most important issue in U.S.-China relations. The stakes, he said, could not be higher. Handle it well, the relationship holds. Handle it badly, the two countries risk collision or conflict. So, in other words, Xi is saying that he is coming for Taiwan. He is going to take Taiwan, and that basically, if we stand back and let him take Taiwan, everything will be cool. If we don't, then we're going to have war. That's basically what he is. That's basically what he's saying there. I laugh at all this. Look, personally, I think all this is a giant waste of time. And I think it's pretty gross that, I'm honestly, I'm just speaking from the heart here. I think it's pretty gross that all of these CEOs went over there with Trump and basically just, kissed the ring of Xi Jinping, and they're all over there fawning over the Chinese, falling all over themselves. Jensen Huang's an embarrassment. He's an embarrassment, man. He can't wait. He is like a Chinese asset, dude. Can't wait to just sell his product to the Chinese, man. The dude makes me sick. It's just this whole stupid motif with the black leather jackets and all this stuff. Yeah. And then the Boeing CEO over there, just like, what do they call it? Like the thirst trap, they're all there, pigs at the trough, man. I mean, it's just ridiculous. Even Elon, even Elon over there, I got to sell more Teslas, man. I mean, it's just ridiculous, dude. The Chinese are not our friends. Okay. People just need to finally get that through their head. These guys, okay, are playing a zero-sum game. They win, we lose. Okay, that's it. I don't care whatever they said here. They're not going to honor any of this stuff. Okay, like, yeah, maybe they might buy a little oil. Maybe they might give Boeing this thing. They're happy to buy the chips from Jensen. Okay, that's fine. Are they going to help with Iran? No, they're not. As a matter of fact, they will probably supply Iran. They probably have already been supplying Iran with more weapons, ammunition, supplies, everything. I'm sure they have. Okay, so they're going to continue to supply Iran. They're not going to help with Ukraine. They're not going to help with any of this stuff. They want us mired in all this nonsense, because when the day comes that they do choose to take Taiwan, they're going to know that our supplies have been massively depleted because of Iran and because of Ukraine. They're going to know that our supplies are depleted, that we're already dealing with all these other issues in different parts of the world, and it's going to be difficult for us to combat them or prevent them from taking Taiwan, or if need be, go in and try to take it back. So again, I don't trust any of these guys. I think they're all completely full of it. And again, and I hate to say that this was a waste of time, but I think a lot of it was a waste of time. And I think it was just a lot of this was just, Trump trying to keep, I think, a lot of these CEOs and a lot of these corporations happy so that he can run around and have all these kudos after the fact to say, oh, look what I did for you. Look at all the business I got you from China and all this other stuff, whatever. Like, yeah, no, it's gross. Okay. These guys aren't our friend. I don't want to do any more business with China. We've done enough business with China. Okay. I'm done. I'm done doing business with China. That's just this is my 2 cents on it. So, yeah. So again, all this. So again, and I think that what you saw in global markets was the reality of what I'm just saying to you now. In other words, if global markets thought that this was really a great thing and this was an awesome thing that happened, you would not have seen interest rates spike up the way that you did. You would not have seen gas prices spike up the way you did. Now, what happened? China said they were going to buy more oil from us, right? That's a good thing, right? But the markets didn't read it that way, and and then China's like, "Oh yeah, we'll help with Iran, wink, wink. Yeah, we'll help out with all this stuff, wink, wink." Like in other words, the market is telling you that this is all garbage, and then a lot of this stuff is not going to happen, and that's why a lot of the market, the bond market, the global market had a lot of the reaction to the way it did because they don't believe this stuff, just like I don't believe any of this stuff. So. All right, let's take a look at the trial here between Elon Musk and OpenAI. That's got Sam Altman and all these other players out there. So let's run through a couple of articles here. So Altman details Musk's OpenAI fallout, says nonprofit was left for dead. So OpenAI CEO Sam Altman concluded his testimony in the Musk versus Altman trial. Elon Musk, the world's richest man, has accused Altman, and other OpenAI co-founder, of trying to steal a charity. Altman answered questions about his role in founding OpenAI, his relationship with Musk, OpenAI's corporate structure, and his brief ouster as CEO in 2023. So, okay, and then we go on here. Now, Nadella, Microsoft CEO, he got called on the stand. Now, Nadella says Musk never raised concerns to him about Microsoft investment. So, Microsoft CEO Satya Nadella concluded his testimony in the Musk versus Altman trial. Elon Musk named Microsoft as a defendant in the lawsuit against OpenAI and its CEO, Sam Altman. Musk accuses Microsoft of aiding and abetting OpenAI's alleged breach of charitable trust. So, all right. Now, I don't think that it doesn't sound like Nadella's testimony was really anything all that damaging to really either side, and certainly not damaging to Microsoft in any real way here. So not to say that Microsoft doesn't have a lot on the line here. They've got, Microsoft has invested, I don't know, 14 billion, $20 billion into OpenAI. So they've got a pretty sizable investment in OpenAI on the line here. That's for sure. But nothing that's like, jeopardizing Microsoft as a company per se. So, all right. And then we continue on with lawyers trade barbs on credibility of Elon Musk, Sam Altman, and OpenAI trial. Musk testified that OpenAI allegedly stole a charity in for-profit conversation, while Altman and others said that the change was essential for raising funds. So attorneys for Elon Musk and OpenAI Sam Altman took turns painting the other's client as untrustworthy on Thursday, wrapping a blockbuster trial with closing arguments that pegged the case's outcome to the credibility of the world's richest man and the leader of its most popular AI lab. The statements closed out the third week of the case, which is litigating the past and potentially the future of the AI revolution, and has featured some of Silicon Valley's most prominent voices. 5 witnesses in this trial called him a liar under oath. Musk's lawyer, Steve Mollo, said of OpenAI's Altman, the comment was part of a lengthy effort to impugn his credibility and leadership of the startup, as well as highlight Musk's allegation that OpenAI acted deceptively when it converted from a nonprofit entity into a for-profit business. William Sabat, an attorney representing OpenAI, said Musk was aware of the plan to convert OpenAI from a nonprofit and soured on the idea when it was apparent that he wouldn't be able to have full control of the entity. After Musk left, those who remained at OpenAI created enormous value. OpenAI is what it is today, despite his predictions of certain doom, he said. To succeed in AI, it turns out all Mr. Musk can do is come to court. Altman defended himself and his leadership of OpenAI on Tuesday, disputing Musk's allegations that he and OpenAI had stolen a charity by converting a nonprofit entity that Musk supported financially into a for-profit venture. I'm very proud of the work that's been done, he said. The trial in the Oakland federal courtroom has sought to untangle Musk's allegation that OpenAI and Altman manipulated him into thinking he was donating tens of millions of dollars to help launch a nonprofit to develop AI for the benefit of humanity, only to turn it into a for-profit venture. Legal experts have described Musk as an underdog in the case, but the remedies Musk is pushing for make the case significant for OpenAI and its executives. Musk is seeking the removal of Altman and OpenAI President Greg Brockman from their leadership roles, and damages worth more than $180 billion to be paid into an OpenAI foundation. The case has gripped Silicon Valley with the glimpse it has offered into the lives of the new titans of the AI age. It comes at a pivotal moment for Musk, Altman, and the AI boom. Musk is racing to hold an initial public offering for his rocket company SpaceX, which merged with his AI startup that had lost ground in the race. OpenAI is also seeking a public listing, although it has lost momentum in its contest with rival Anthropic. Musk lawyers sought to highlight his concern about the impact the AI industry could have on the world. In testimony, he called himself a fool to back OpenAI. OpenAI's lawyers tried to demonstrate that the conversion was necessary in order for the startup to be able to secure the funding required to improve its AI technology. Even with the conversion, OpenAI has a foundation that owns a sizable portion of its shares. OpenAI attorney Sabat said some estimates put its value at $200 billion. Yeah, and who controls the foundation? Sam Altman does. And who lied to the board about the creation of the foundation? Oh, that would be Sam Altman. That was one of the reasons why he got fired. Has anyone heard of a bank robbery where the bank robbers entered the bank and put $200 million into it? Yeah, but that's not really true. That's not really how that went down. The trial also revealed the existence of Brockman's personal diary, in which he confided his financial dreams. Financially, what will take me to $1 billion? Read an entry that was entered as an exhibit in the case. In the trial, Altman and Brockman disclosed significant details about their financial holdings, including personal investments in companies with which OpenAI has completed deals. Musk's attorney highlighted the wealth OpenAI has created for core executives, including Brockman, whose stake in OpenAI is now worth close to $30 billion. What could possibly be wrong with that? He asked the jury. A lot. Okay, so ultimately, and then I think I've got one more article on this. Yeah, a messy courtroom drama over AI's biggest breakup. The legal showdown between Elon Musk and Sam Altman revealed the personal and financial fault lines between Silicon Valley's defining boom. So, U.S. District Judge Yvonne Gonzalez Rogers opened the last day of testimony in the Titanic trial between Elon Musk and Sam Altman's OpenAI with a simple question: should a trophy of a golden donkey's backside be entered into evidence? The judge held the statue in her hands with a bemused look. Dario Amodi, then a team lead for AI safety, had helped award it to a company intern years earlier after Musk called the person a jackass for challenging him over AI safety at a company meeting. We think it's pretty obvious this trophy has no relevance, a lawyer for Musk said in court. Gonzalez Rogers opted to allow a photo of the statue given to Joshua Akim, now OpenAI's chief futurist, to be admitted. The actual statue was put away before the jury of 6 women and 3 men could see it, although they were shown a photo. So went the landmark legal showdown between some of the most powerful players in AI. The 3-week trial, now in the jury's hands, was technically about allegations by Musk, the world's richest man, that he was snookered into fronting OpenAI millions of dollars as a struggling nonprofit, only to see it morph into the world's most powerful AI company. Let me scroll down here a little bit. Da, 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 da. Hang on. I just wanted to get to your Clash of the Titans. So ultimately here in the trial, basically I think that things have been, let me see here. Yeah, it's just, yeah, all right, whatever. Okay, so we're gonna skip through the rest of that there. So anyway, so if I can boil this down, I'm trying to think, how do I want to describe this? So if I could boil this down to make this real simple for people who are not familiar with this trial or what really happened here. So for people who don't know, Elon Musk was basically the founder of OpenAI. Okay, he created it with Sam Altman, a bunch of these other people. Now, when they originally created the company, it was created as a nonprofit, and Elon Musk put, billions of dollars of his own money into developing the company. Then all of a sudden, a lot of the people involved began to basically say, like, oh, well, no, we need to make this a for profit because, we're all putting all this work into this and we all want to get rich. And Elon basically pushed back on that notion and basically said, no, we're not going to do that. That's not what this was intended to do. And oh, by the way, it's my money that you're using. So no, we're not going to do that. Right. So then it got to a point of contention, to the point where basically Elon decided to walk away. He basically said, "Okay, forget it. I'm done. I'm out of here." And he picked up his ball and he went home. And Elon basically thought that that was going to be the end of it. That OpenAI, without his funding, without his talent, would basically fold, and they were doomed to failure. They were going to fold, and that was going to be the end of it. Okay, so then lo and behold, OpenAI actually does pretty good. They start to develop a product. They start to get a lot more money and investment in the door, particularly coming in from Microsoft. And they get, obviously they got, $14 billion at least from Microsoft, if not more than that. And so they really took off. And then, Sam Altman, he created this foundation and this fund where, he created basically, Sam Altman basically worked to create all these different structures. And the problem for Sam Altman is that he's a pathological liar, and that basically, he lied to Elon, he lied to the board. That's what got him fired for a couple of days. The only thing that saved Sam Altman when he got fired was Microsoft, because Microsoft he ran back to Microsoft crying, and Microsoft basically came back and said, no, this is we've got $14 billion into you guys, and we have this massive investment. And no, Sam Altman's our guy. He's going back in. And that's what saved his bacon and got him back in there. Now, they want to convert from a nonprofit to a for-profit, which is just ridiculous. I don't know that there is really any kind of precedent for this. And the court did rule, however, that they could create this. They've got to create this kind of bastardized corporate structure, if you will, where you're going to have this for-profit entity that's going to be owned by the nonprofit, but the nonprofit's going to oversee the for-profit. But ultimately, these guys got their wish. They're going to have a for-profit entity, which is going to turn them all into billionaires. And that's what they were looking for. That's what they wanted to do from day one. So I think Elon does have a case here, and I think he does make some valid points. But at the same time, what hurts Elon in this conversation is the fact that he did walk away. The fact that he did walk away from this thing, and that is, therein lies the problem. I think if Elon had stayed involved and these guys had taken it into this direction, I think Elon would probably have a much stronger case of basically saying, like, yeah, these guys shafted me and these guys did something that they weren't supposed to do. But I think with him walking away and them not only surviving and thriving and getting investments in different people and having the court rule for them in terms of the whole nonprofit structure they wanted to create, um, that kind of changes the game. Do I think much of these guys of Greg Brockman and Sam Altman and all these other? No, no, I don't think much of these guys. I don't think any of these people are good people. I think these people are all massively narcissistic and are just driven by pure greed, and their whole desire is just to become billionaires and become Silicon Valley players, if you will. I think that's all they really care about at the end of the day. I don't really think they care about bettering humanity or any of that. I think that's all nonsense. And if AI, wrecks the place in the process of all this, they don't care. They could care less. So again, it's a very interesting trial. Like I said, there is a jury, but I believe it's ultimately up to the judge in this case as to what ultimately happens here. I think the judge has got the final decision here, if you will. So it'll be very, very interesting how this ruling comes down. And my guess is if I had to take a guess how I think this is going to play out, and we'll find out here, right? Probably what in the next week or so how this is going to play out. My guess would be that the judge is going to say, okay, Elon, yeah, they did some things that were probably unethical and probably against what you were looking for. Probably have them pay some kind of fine or do something or whatever. But ultimately, I don't really think this changes anything. I don't think that these guys are going to get tossed out. I think the judge is going to say, yeah, you know what? Are they Boy Scouts or people of high moral and ethical standards? Like, no, they're not. But is that enough to get them removed from the company? Probably not. But like I said, we'll keep an eye on that and see what happens. Okay. I've got a lot of private credit news here, and I'm gonna have to go through this a lot faster than I was planning on here. But first thing up here, the PE private equity paradox, like volatility fuels new deals as old assets sit frozen in portfolios. So glinting investment opportunities abound, private equity firms say, but the industry also faces an exit bottleneck of over $3 trillion. Now, I did an episode on this just a couple months ago, basically about all these companies that are sitting in private equity and they've got this massive, you can see here from this chart, US PE portfolio companies. You can see 2026, you've got 13,000 portfolio companies. So they have this massive backlog of companies that they need to unload and can't really unload. So it's a very, obviously, private credit playing in a big issue in this. Private equity exit value falls. So first quarter U.S. private equity exit value fell to 144 billion. So at a time that they need to unload a lot of these companies, a lot of times the value is really dropping here. So not that they can't make money, but they're not going to make as much money. That's the problem, at least for them. So very interesting there. Like we'll keep an eye on this. I don't think this problem is going to get any better or any easier for them in the near future. But let's see here. Private credit's hot streak is over. Firms attribute the decline in returns to Fed rate cuts and rising defaults on their loans. So we see here Apollo, Blackstone, Blue Owl. Let's see here. Private credit gross returns in the first quarter. So you can see there, yeah, returns are way down. Yeah, and I think these numbers, I would say, are going to get worse. So private credit firms' returns are entering a more modest chapter with recent earnings showing declines after a period of high performance. So let's see here. What do we have here? So Fed eyes increased FDI lending disclosures for large banks. So the Federal Reserve will soon require banks to disclose more information about their lending to non-depository financial institutions in an effort to gain more insight into the lending segment. The Fed plans to update its reporting requirements so that the nation's largest banks will have to provide regulators with financial information about the NDFIs they are lending to, such as total assets, net income, and leverage that enable the bank's credit underwriting and ongoing risk assessments. Vice Chair for Supervision Michelle Mickey Bowman said on May 8th, the shift comes as banks' NDFI lending has surged in recent years and raised concerns about risks. Yes, absolutely. And then we get into this. Banks disclose first quarter 2026 NDFI exposure amid continued regulatory concerns. So, and then you know what? I probably need to make this a little bit bigger here. U.S. banks disclosed their first quarter loan exposure to non-depository financial institutions as regulators signaled a desire for more information on the segment. So let's look down here. So we got some great charts here on a whole bunch of the biggest banks. So U.S. Bank Corp here. So what we have here at the bottom these are the 5 different categories of non-depository financial institutions. So we have private equity, business credit, mortgage credit, consumer credit, and then other. So we can see here, so U.S. Bank Corp, they have their biggest segment here is in private equity. And let's go to PNC. PNC almost tied here for business credit asset securitization and private credit or private equity. So again, Truist, business credit, massively high here at Truist. Let's see here, Fifth Third Bancorp, subscription lines, 2.3. Let's see here, corporate credit facilities followed by real estate. Huntington Bank shares. Oh, other. Huntington Bank shares, very big on other. It's interesting. First Citizens Bank shares, capital call lines, 21.7. Very interesting. Citizens Financial Group, capital call facilities, again, 6.1%. M&T Bank Corp, mortgage credit. So M&T is more focused on the mortgage credit in here. That's very interesting. Key Corp, private credit, specialty finance, and institutional real estate. So there you go there. And then Regions. Other Regions, very big in the other bucket. And then finally, Pinnacle Financial Partners, very big on the business credit and other. So again, this is just very interesting information. Gives you a very good snapshot into what the focus is amongst these big banks on the different the lending to non-depository financial institution buckets, if you will. So, all right. The more you know about this private credit fund, the less you understand. So a close look at Blue Owl Credit Fund's holdings raises questions about its valuations. So again, one of the things we've talked about with, again, part of the reason why I showed the private equity article here is that one of the questions going on has been this idea of inflated asset values, inflated net asset values. And obviously this article basically gets deeper into Blue Owl, basically talking about how, yeah, you look at what's going on with Blue Owl and you're kind of left shaking your head because a lot of the asset values are inflated. A lot of the stuff is not going the right way. And Blue Owl has been the punching bag, if you will, for the private credit market this year, at least one of them. KKR Private Credit Fund takes a $560 million loss. Firm will invest $300 million in an effort to bolster fund as loan defaults climb. But wait a minute, I thought this was all one-offs. I thought, wait a minute, I thought this was all one-offs. Largest private credit fund held by individual investors took a $560 million loss in the first quarter when a growing number of loans tipped into default. The write-down, equivalent to about 10% of the fund's net asset value, is one of the biggest indicators so far of underlying problems in a large private credit fund. Defaults in the fund jumped to 8.1% in the first quarter from 5.5% in December. The $12.3 billion fund, a business development company called FSKKR Capital, has been under pressure since last year when it disclosed its largest investment was underwater. The stock tumbled further this year when big loans to software maker Medallia and dental service company Affordable Care went into default. Now, I did a whole episode just 2 weeks ago on the failure of those two companies if you want to go check that out. But let's go on because I just have a couple more things here with this. So JP Morgan Chase led bank group reins in credit line to troubled KKR private credit fund as losses mount. So more trouble here for KKR. So JP Morgan led lenders cut FSKKR's capital's credit facility by roughly 648 million or 14% while raising borrowing costs. FSKKR reported deepening losses and announced a 300 million support package from KKR for the troubled BDC days after the credit line amendment. The fund, known by its ticker FSK, reported roughly 560 million in first quarter losses as non-accrual loans climbed to 8.1%. So JP Morgan and their lender group basically cutting their line of credit to the KKR fund. So, oh, look at this. And of course, this came out yesterday on Friday afternoon after the market close, I might add. Federal prosecutors are now probing BlackRock private credit fund. You don't say. Publicly traded BlackRock fund known as TCPC has been marred by write-downs and poor performance. So federal prosecutors are probing a BlackRock private credit fund that surprised investors with a sharp write-down of its loan portfolio earlier this year, according to people familiar with the matter. The Manhattan U.S. Attorney's Office is investigating the valuation practices of BlackRock's publicly traded TCP Capital Fund, the people said. Bloomberg News earlier reported on the probe. The fund's poor performance has been a sore spot for BlackRock, though its roughly 350 million market value represents a negligible portion of the assets of the world's largest investment firm. In January, the fund disclosed a 19% decline in the net asset value of the investment it owns, writing down the value of a number of loans that its managers had marketed at or near cost just a few months earlier. Shares of the fund have dropped 45% over the past year and trade well below the stated net asset value, the manager's estimate of what the portfolio is worth. Because many private loans rarely or never change hands, marking their fair value is a subjective exercise. Many managers use third-party valuation firms to come up with estimates, which are typically reported quarterly by private credit funds that are marketed to individual investors. Skepticism over those valuations began to bubble up last year, prompting investors in public funds like BlackRock's to sell shares, and investors in so-called non-traded private credit funds, a larger segment of the market, to ask managers for their money back en masse. So, okay, and then we get to private credit blowup leaves 1.7 billion missing and 6 Ferraris found. So bankruptcy administrators allege Market Financial Solutions MFS owner Paresh Raja transferred more than $500 million into his personal accounts. You don't say. UK mortgage lender MFS left Barclays, HSBC, and Apollo Global Management facing hundreds of millions of dollars of potential losses when it collapsed in February. Now, bankruptcy administrators allege its owner, Paresh Raja, moved around 550 million of MFS borrowed funds into personal bank accounts and then bought luxury cars, including 6 Ferraris and 3 Rolls Royces. A spokesman for Raja said that he strongly denies the allegations and that there was no fraud or dishonesty. Assets which the administrators characterized as missing were held through nominee structures for the benefits of MFS and its creditors. Okay, whatever. The UK commercial court where the bankruptcy is playing out applied a freeze on Raja's worldwide assets in March. Now, I believe Raj here, he fled over to United Arab Emirates or something like that. Yeah, he's out. He took a whole bunch of money and blew out of town, and he's basically hoping that they're not going to extradite him back for a trial. So, and then I have here, First Brands faces U.S. push for trustee-led liquidation. So the U.S. bankruptcy watchdog said the auto parts supplier improperly favors some professionals and lenders in its proposed plan. So the U.S. government on Wednesday asked the bankruptcy court in Houston to convert First Brands Chapter 11 case to a liquidation or dismiss it entirely, deeming the business insolvent. The U.S. Trustee's Office, a division of the Justice Department that acts as a bankruptcy watchdog, said the auto parts supplier has no realistic prospect for reorganization and should be wound down through a federal government-led liquidation to save costs, according to a court filing. The government said under the current restructuring plan, First Brands plans to set up a litigation trust to pursue legal claims using proceeds to repay certain creditors. The company also plans to pay professional fees of more than $245 million in full, while as much as $223 million in administrative expenses would remain unpaid as of the bankruptcy's plan's effective date. So so there's just a quick update for you. So MFS, they repossessed all the dude's Ferraris and his Rolls Royces. And then First Brands basically now, basically just pushing for a full liquidation of the company. So, all right. And then this was the last article here on private credit isn't a major threat, probably. Now, this was written by James McIntosh. I have a lot of respect for James McIntosh. He's a very good writer over at the Wall Street Journal. He's been around for a very long time, has written a lot of good stuff, very smart guy, versed in a lot of things. But, he's coming out here as like, well, he's coming up with the standard media trope of like, yeah, we're just seeing a couple one-offs here, not too much to worry about, not a big deal, won't really, become a big issue in the broader economy, whatever. Like I said, I'm not buying that yet. Like, I still think that private credit is a massive bubble, and it's a bubble that is still being fed. And because it's a major growth driver for the major big banks in this country, and it's a problem. It is a very, very big problem. So, all right, enough on the private credit stuff. So I just have a couple more articles here, guys. We're going to try to wrap this up in the next 5 minutes. Average student loan defaulter is nearly 40 years old. So older student loan borrowers have been falling behind since the federal government ended its pandemic era payment pause. So borrowers hitting 90 or more days past due on their student loans by age, 50 plus, and then 40 to 49. This is pretty crazy. I mean, pretty high ages, man. Pretty high ages out there. That's pretty crazy. And then here's another one. There is a fire sale on MBAs. With applications down, more business schools are offering discounts on specialized degrees that promise AI era training. So business schools at Purdue University, Johns Hopkins University, and UC Irvine are offering steep tuition discounts. One of America's most expensive graduate degrees is going on sale. More business schools are giving steep discounts on tuition that could save students up to 50% or tens of thousands of dollars a year. For professionals who are considering whether to go back to school, it can offer a pathway to get a degree while staying debt-free. But for the schools, many of which have struggled to attract applications, the discounts may not be sustainable as a business model. So, without getting into a ridiculously long conversation here on MBAs, here is the problem with MBAs. MBAs are very expensive. The bottom line is this: MBAs do not do for people what they used to do. It used to be, you go back to the 80s, even into the 90s, the MBA was the fast track to the executive ranks. You got an MBA, and boom, you were in. Like, that's it. That's all. It's basically all you had to do was go back, have a little work experience, get an MBA, and bang, you were on the fast track into the executive world. That's not true anymore. That's not true anymore. And part of the problem is especially in your I believe in your metropolitan areas, your major metropolitan areas, so many people have gotten MBAs that MBAs have become very, very watered down. And the problem is the MBA, and again, I have an MBA. I'm not poo-poo. Look, I loved the experience of getting, when I went back to get my MBA, I felt like I learned a tremendous amount when I got my MBA. When you get an MBA, you study a lot. I think the best part of the MBA, of getting an MBA, is you study all of these business cases, and you analyze all these different companies from all different perspectives, and you have all these conversations with people that are brought into class, with the teachers, with your other classmates, about all of these different things going on with companies, and a lot of it is a lot of fun. You basically you talk about um okay, what was the business strategy here? Why did this company fail? Why did this company succeed? You really break down and analyze a lot of different corporate strategies, and you get into all different aspects. You get into finance, you get into sales, you get into marketing, you get into branding, you get in, you like you just you get into to all these different parts of a company. You get into very sophisticated stuff like studying Michael Porter's value chain. You study things like what do you think, like blue ocean strategy, and all these different things, all these different tools, if you will, for how you can analyze, SWOT analysis, all these different ways of analyzing a company. What is company? Michael Porter's his I can't think of the name of it. His competition model, and the diamond, but Porter's diamond, and all this different stuff. Like there's all these different things that you study, and you begin to amass this big toolkit for how you can dissect a company, right? You could dissect their strategy, how they do things. You could come back and help to make changes to hopefully make things better, drive revenue, make the company more efficient, more streamlined, all that kind of stuff. So again, there is still I think a huge value in having an MBA. I just think the problem is it's gotten very watered down, and it doesn't do as much as it's just like I said, there was just too many kind of people running around with MBAs. Um, and unfortunately, I want to say that I think a lot of people are, I think one of the problems of things that have happened are like people, like I see young people all the time that like they're in college and to get they stay that extra year to get that MBA, right? So now it's like they get out and it's like, oh, I've got an undergrad degree in this and I've got an MBA, but they have no work experience. Like I waited 10 years before I went back to get my MBA, and I think that was the best thing, because I think having that 10 years of work experience brought my business acumen way up, my real world understanding of business way up. And so I think I got a lot more out of it when I went back to study, and I understood a lot deeper a lot of the concepts and a lot of the things we were being taught. Um, but that being said, ultimately the MBA it's just not the instant, the road to riches that it used to be. That's just the bottom line. And a lot of people just don't have the respect, I think, for a lot of MBAs anymore. I've heard employers say like, man, I would never hire another MBA, because they've been so disappointed with the results of people that they've hired with MBAs, which is in and of itself kind of fascinating. Um, but it also shows you how watered down the degree has become. And then schools have gone to gimmicky things. Oh, we'll take the 1 year executive MBA, do this, do that. Now it's become a fight of, because it's dropped off so much. Now it's become a thing of, and the other thing is undergraduate tuitions, right? The explosion in undergraduate tuitions has caused big problems. So as far as people just not being able to afford to go back and get the MBA. Um, so again, but now the MBA programs are like, I'm sure they're like, oh, we're going to tailor it more to just make it an AI specific thing and lower the cost and try to induce people to come back. But it's going to be tough. It's going to be tough, but we'll see. But it was an interesting article here. So, okay. Last couple things real quick. Senate panel approves crypto bill, the Clarity Act I had mentioned a little while earlier, with stablecoin yield language intact, moved to the full Senate. Some last minute amendments resurfaced, but an anti-money laundering measure was denied. So again, we'll talk more about this. Coinbase CEO says crypto bill could transform U.S. financial system as the Senate vote approaches. So lawmakers race to establish clearer crypto rules as banks increasingly integrate stablecoins and digital asset services. And then finally, Crypto industry notches win in Washington after brawl with banks. Marquee crypto bill advances past key Senate committee following furious lobbying campaigns by both sides. So the Senate Banking Committee approved a bill that would establish rules for cryptocurrency regulation across the SEC and the CFTC. A bill that would create a pathway for crypto to further upend the world of traditional finance moved one step closer to Law Thursday, the latest testament to the sector's influence in Washington. The Senate Banking Committee approved a bill that would establish rules regulating different types of cryptocurrencies across the Securities and Exchange Commission and Commodity Futures Trading Commission. Two Democrats joined the committee's Republicans in passing the legislation, potentially putting it on path to clear the full Senate. But we shall see. You know, the language is, I think the language went more in favor of banks, but not completely. You know, banks thought it was better, but they weren't fully in love with it. So, and my point that I've been saying for the last few weeks that I thought the crypto lobby needed to get is that I think for them, it's more important just to get this passed. You know, you can work on it and amend it in the years to come. It's more important to get it passed and get things rolling, I think, for them. They probably don't see it that way, but, you know, but so be it. All right. We will talk about, like I said, we will talk about this more in coming weeks, and I will also cover this a lot more in my crypto series. So if anybody I do a crypto series. Anybody wants to go check that out, go to the YouTube page, go down the playlist to the crypto series. There's 40 episodes right now in there. I cover all things crypto in there. So I'll probably be talking about this more in that episode, but also more in the coming weeks in the live stream as, you know, we get more information. So, all right. That's enough of all that tonight. I'm now going to go into wrap up mode. So we're going to do our story of the week and our quote of the week. But before we get to that, I got to go through my wrap up items, which means I need my banners. So, okay. If you were watching or listening, I should say, if you're listening on Apple Podcasts or Spotify, please make sure to leave me some reviews, as that would really help the channel. So again, if you're on Apple Podcasts or Spotify, please leave me some good reviews. Make sure to visit www.thebankernextdoor.com. That is the official website for the channel. A lot of good things on there. Go check that out. Make sure to subscribe on YouTube to get the latest and greatest via posts. You could send comments to info@thebankernextdoor.com. So if you have questions, comments, topic recommendations, that's how you get in touch with me. info@thebankernextdoor.com. You can follow me on social media. I am up on Getter, X, and Truth Social. I will tell you I spend the most of my time on X, but you can follow me on those platforms right there. Also, BND is on YouTube, Rumble, and all major podcast platforms. We have new episodes every week, Monday through Friday, premiering at noon, and the BND Strategy Room live stream every Saturday night here on YouTube at 8 p.m. So that is that. So now let's go to okay, well, story of the week. Let's go story of the week here. So initial public offering, IPO. An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. An IPO allows a company to raise capital from public investors. The transition from a private to a public company can be an important time for private investors to fully realize gains from their investment, as is typically includes a share premium for current private investors. Meanwhile, it is also allows public investors to participate in the offering, and that is an initial public offering, also known as an IPO. All right, now our quote of the week. So this comes to us from the famous author Ernest Hemingway. This goes, "The best people possess a feeling for beauty, the courage to take risks, the discipline to tell the truth, the capacity for sacrifice. Ironically, their virtues make them vulnerable. They are often wounded, sometimes destroyed." So again, very deep quote. I have a bunch of quotes from Ernest Hemingway, and a lot of them are like that. They're very deep. If anybody knows, Ernest Hemingway did suffer from depression. He did commit suicide at the end of his life. a lot of people believe, Ernest Hemingway lived an insane life. I mean, he was involved in World War I, World War II. He sustained a lot of concussions and head injuries in his life that could have led to the deterioration of his mental state, particularly towards the end of his life. But a lot of his quotes are very intelligent and very deep. I'll put it that way. So, all right. That being said, hey, long night here, long live stream, but I thank everybody for hanging out with me on this a Saturday night. I appreciate you being here in the strategy room with you. I hope everyone has a great weekend. I can't wait to see what happened with the Ronda Rousey Gina Carano fight. If they started fighting, they probably already had the fight already, but I don't know. We'll see. Definitely can't wait to check out, see who wins the PGA Championship tomorrow. But with that being said, I hope everyone has a great weekend out there. Thank you for watching and listening. Be back here next week for another live stream of the Strategy Room, and I will see everybody again real soon.